more. Equity futures doing okay as well. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research as JP Morgan kicks off bank earnings. Jennifer Flitton of Invesco with Trump's cabinet picks on Capitol Hill. And Greg Peters of PGIM Fixed Income as we count you all down to inflation data at 8:30 Eastern Time, about 86 minutes away. We begin this hour with stocks rising ahead of CPI data and better than expected results from both JP Morgan and from Wells Fargo. Joining us now to discuss is Ken Leon of CFRA. Ken, you've had about 15 minutes to pore over those numbers. What do you make of them?
Well, it's great. So we had outsized gains for these stocks last year. And what the results speak to is the ability to earn into your valuation. I would expect the street is going to have upward earnings revisions for 2025. Take a look at 2026. As noted here, what's the delta for driving that earnings? And that's about really for JP Morgan first would really be net interest income. So it's not just rates as noted here, but it's also volume, which speaks to the U.S. economy growing about 2.5%. Those two flywheels drives net interest income, which is significant for JP Morgan and other banks. The other delta that we haven't spoken about is investment banking, and it might start slow, but the ability of a risk-on environment for mergers and acquisitions and also equity underwriting means that we're going to be moving further up from the trough of the market or the cycle about 18 months ago. Additionally, when you look at, again, net interest income, but JP Morgan is a diversified bank, so it's getting that from many different types of services. The only negative here in the print was really community banks, a little bit slower in terms of their net revenue. But mostly this is a monolithic global bank, well-placed, trading at an expensive valuation. Our takeaway is stay the course, and they're going to grow into their earnings and valuation.
Ken, another figure, fourth quarter provisions for credit losses came in at $2.6 billion. The estimate was higher at just over $3 billion. Similar story for Wells, a lower number than expected too. What does that say to you about credit quality? Are we in a period or at least getting very close to normalization?
Yeah, for JP Morgan, then the industry. So bank analysts are a nervous lot, and the concern is always on credit risk and major write-offs. And so far, the economy is resilient. We're nowhere near an amber or red alert in terms of significant need for buildup of credit reserves. Looks like we're going to have a pretty good year for the economy. And when you look at the consumer, certainly, as you do see increases in allowance for bad debt, it's mostly because the volumes are much higher today than they were 2 or 3 years ago. Ultimately, and we didn't speak about this, which is whether it's on credit risk or on trading, is that black swan event. So Jamie Dimon mentions geopolitical risk. The third I would ask is some liquidity squeeze in a complex trading product that upsets the market and maybe the bank stocks. We haven't seen it here. If you go back in 2023, that was Credit Suisse.
Hey, Ken, appreciate your time. Before you go, we get Goldman in about 25 minutes' time. What kind of companies do you think we should be owning this year on the banking side within the sector? Do you think we need that higher capital market concentration or stick with the traditional names?
I'm believing in a strong delta here for Goldman Sachs. So we have a strong buy in Goldman Sachs. Only 15% of total net revenue comes from net interest income. So it's on fee service revenues across all its businesses. I like the announcement earlier in the week where they're trying to get a front row seat for private credit. John, we're going to be speaking about that more this year. I like where Goldman is. The rear mirror, of course, was the failed strategy with retail consumer banking. Goldman's going to do fine.
We'll spend more time talking about Goldman when those numbers drop at about 7:30 Eastern Time, a little more than 20 minutes away. Ken, stick with us and stay close. Ken Leon there of CFRA. Joining us now to extend the conversation, Ed Yardeni of Yardeni Research. Ed, welcome back to the program, sir.
Thank you.
Equity futures up by 0.4% on the S&P. Did these numbers from these banks give you the all clear on this economy?
I think so. I think the banks are very important. Usually bull markets aren't sustainable unless the financials are doing well, unless the banks are doing well. And they certainly do seem to be doing very well. The economy is growing, loan demand is growing. And as you've been pointing out, we've got a new administration that's going to be easier on regulations. And as a result of deregulation, the banks are going to benefit from that. As a matter of fact, I think that the most obvious beneficiaries immediately from the new administration.
Ed, when you look at the overall market, it is easy to make the argument, as so many people do, is that it's overvalued. It's too expensive. Everybody wants to own the U.S.
Yeah.
Is the fact that banking is justifying some of these valuations, that they're pushing higher in their estimates, negate some of those arguments that we've heard to start this year?
Well, I think everybody believes that valuation is to a large extent determined by the interest rate situation, the inflation situation, and there's a big belief in reversion to the mean. And right now we've got the forward PE on the S&P 500 running around 22. The peak right before the tech wreck in 2000 was 25, so it's making everybody nervous. I think what drives the valuation multiples is the perception of how long the expansion is going to last. And we just had, over the past 3 years, the most widely anticipated recession of all times that didn't happen. And it made sense that we might have had a recession because the Fed tightened, but the economy's been resilient. And it, I think, demonstrates that it might be able to continue to grow right through the end of the decade. If that's the case, then earnings are going to, in fact, be able to grow and basically meet the expectations of some of these high PEs. So I'm not particularly concerned about that if the economy continues to grow, which I think it will, and if earnings continue to beat expectations, which I think it will, because I see productivity making a big comeback.
And you make a really good point. One of the key words you said there is grow through the next decade, because pricing in forward earnings isn't about next year. It is about the forward longer term outlook. Does that mean any of these gyrations you're seeing at the moment, be it from concern about fiscal policy, be it about where yields are today, that this is an equity market that can look through it because of the resilience for some time to come?
Yeah. Well, look, I think the big hurdle right now, or challenge for the stock market from going higher, is the bond market. Everybody's talking about 5% and maybe higher on the 10-year. The 30-year is basically just about there. And that's got everybody somewhat nervous. I mean, 5% is an awfully good yield, especially if inflation is going to be close to 2%. So we may see some rebalancing here out of stocks and into bonds. But all in all, with the economy likely to grow better than expected because of productivity, I think that's good for earnings, and that's good for the stock market. And I think it's going to take a little while here to get some clarity on what this administration's policies are going to add up to. But I think on balance, I'm optimistic that they will be positive for the market.
Well, that's one of the risks that Jamie Dimon talks about in this release. He says ongoing and future spending requirements will likely be inflationary, and therefore inflation may persist for some time. Ed, if this is the environment and inflation doesn't start to weaken the way we were trending down, is there a chance we could see the Fed have to come out and not just be on pause, but actually maybe hike?
Yeah, I started to hear people raising that possibility a month or two ago. We went from the market thinking several rate cuts at the end of last year, and that was fueled by comments from Fed Chair Jerome Powell that the 50 basis point cut back in September 18th for the federal funds rate was the beginning of several rate cuts, and they've started to walk it back, and now I think everybody expects a long pause. I think none and done this year. I don't think they're going to be raising interest rates. I think inflation may be a little sticky, maybe a little hotter at the beginning of the year, but I think it will continue to moderate because of productivity, because China is depressed. I think if we have an inflation problem from tariffs, it'll be sort of a one-off situation and won't be an ongoing inflation problem. So put it all together, and I think that, no, I don't think the Fed's going to be raising rates.
Just before you go, you coined the phrase, bond vigilantes.
Yep.
We often talk about that. A lot of people are wondering whether they have actually returned, or whether we're just pricing in better growth, a better outlook for the US economy. And when I look at twos, and we'll look at where 10s are trading, the 2 years trading basically in line with Fed funds. The 10 years about 40 basis points north of that. That all looks fairly normal. Is there any evidence that the bond vigilantes are actually out in the United States and have made a comeback?
Well, I think you're making a good point, and it's not completely clear about the bond vigilantes, because the bond yield is actually back to normal, in my opinion. It's back to where it was before the great financial crisis, and let's take a wide range here of 4 to 5%. That's kind of where we are, and I think that's fine. But it's kind of the speed at which we get these things. I mean, back on September 16th, we were 3.65%. And now we're, everybody's talking about 5% as kind of the next stop. So I think that a lot of it is, in fact, better than expected growth and stickier than expected inflation. But this has all meant that the Fed's on pause and the bond market has reacted to that. I do think there's some bond vigilantism out there. And I hope that Trump's advisors, like Scott Bessent, does what Robert Rubin did for Bill Clinton and warn him that we need some fiscal discipline to avoid the bond vigilantes taking over law and order in the capital markets. Yeah, well, we've not had much of that over the past few decades. Ed, appreciate your time, sir. Ed Yardeni of Yardeni Research on the bond market and the return potentially of the bond vigilantes. If you are just joining us, welcome to the program. We had JP Morgan numbers come out about 25 minutes ago. The outlook, pretty decent, quite solid for 2025, and traders in the fourth quarter, a record quarter. The stock is higher by about 1%. The gain's just fading a touch, though, in the pre-market. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hakes. Hey, Yahara.
Hi, John. Southern California remains under severe fire threat. An army of firefighters spent yesterday putting out small fires before they got out of control. They also continued building containment lines on the larger Palisades and Eaton fires in hopes of preventing them from spreading. The fires are expected to be the most costly in U.S. history, destroying what officials estimate could be more than 12,000 structures, including many homes. Meanwhile, in China, the distressed developer Country Garden suffered another record loss in 2023. In the results, which were delayed, the builder blamed the loss on a huge impairment provision on properties under development and completed homes for sale. Country Garden says it still has more than 3,000 projects left to sell, with inventory worth more than $82 billion as of mid-2024. Meanwhile, Elon Musk's SpaceX has had another landmark launch. A Falcon 9 rocket with a pair of commercial satellites on board took off from the Kennedy Space Center overnight. Both satellites are carrying lunar rovers. One from Texas-based Firefly Aerospace will attempt a moon landing in 45 days. The other is owned by Tokyo's iSpace. It will try for its second trip to the moon after a failed attempt last April. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next on the program, Trump's nominees get a grilling on Capitol Hill.
What became very evident to us from the beginning, there was a coordinated smear campaign orchestrated in the media against us. It is time to give someone with dust on his boots the helm.
A conversation up next, live from New York this morning. Good morning.
Is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
From the the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg.
Bank earnings so far, pretty good. Numbers from JP Morgan, from Wells Fargo as well. Goldman drop in about 12 minutes' time. So equity futures rising by 0.4%. Bond yields a little bit lower. We're down 3 basis points, 476. Later on this morning, 1 hour, 11 minutes away, CPI in America. Look out for that a little bit later this morning. Under surveillance, Trump's nominees get a grilling on Capitol Hill.
What became very evident to us from the beginning, there was a coordinated smear campaign orchestrated in the media against us. It is time to give someone with dust on his boots the helm. A change agent, someone with no vested interest in certain companies or specific programs or approved narratives. My only special interest is the warfighter.
So here's the latest this morning. President-elect Donald Trump's Pentagon pick, Pete Hegseth, appearing on course to win confirmation, dismissing accusations of past misconduct in his Senate hearing. Secretary of State nominee Marco Rubio, among those speaking on Capitol Hill later on this morning. Then Treasury Secretary nominee Scott Bessent appearing on Thursday. Joining us now to discuss, Jennifer Flitton of Invesco. Jennifer, welcome back. Any reason to believe that some of these nominations might be in trouble? Any trouble at all?
Well, I think what we saw yesterday is that a lot depends on these hearings. And objectively, Pete Hegseth did a pretty good job, and it is now taking him on the path to confirmation. I think he'll skate through the committee approval, and he'll be on the floor probably sometime next week. The other more controversial folks like Tulsi Gabbard or Robert F. Kennedy Jr., I think these hearings are really going to matter. And if they have some of the same showing as Pete Hegseth did, then I think they're well on their way to confirmation.
Jennifer, if they're going up for the hearing, though, the Trump campaign must think that they have the votes for these individuals like Tulsi Gabbard and RFK Jr.
Well, I think they have faith in their strength, right? And one thing that is sort of a through line with all of these nominees is their strong ability to communicate, their ability to message and stay on message. And I think you're going to see that with Tulsi Gabbard and with Robert F. Kennedy Jr., with Patel for the FBI director. If they have strong showings at their hearings, and I think the faith there is with them from the transition, then I think they're well on their way to confirmation. And what we're hearing behind the scenes with the meetings that are happening with the senators is that they're gaining a lot of support as they move along.
It's a good point you make, because that's what sources close to Trump tell me, that being able to communicate his agenda is just as important as being able to do the job that he's putting some of these nominees in place. Can you give us a sense of what's so different from Trump 1.0 and how they worked with nominees and some undersecretaries and what we're seeing now? Are they moving faster now?
They're definitely moving faster. I mean, I think the vetting was a little slow because of how they decided to do it and when they brought in the FBI vetting and when they started filing with the Senate. But I think they're well within their way, well on the path to getting folks in immediately as soon as the president is inaugurated on day one. I do see a much sort of stronger bench in the sense of the ability of Trump and the Trump transition team, and really Susie Wiles at the top there as the chief of staff, to get folks in who are really speaking the message of Trump and Trump 2.0. I think in 1.0 you saw sort of the mechanism in Washington really working to influence Trump. Now Trump has a very strong position and has a whole team of folks who are there to push that position, to push that agenda.
Beyond just the ability to get these various cabinet members confirmed, Jennifer, does it also speak to a cohesion within the Republican Party that will benefit Trump as he tries to do things like pass one big, beautiful bill in a very slim majority? Does it help that these are getting through? Does it speak to that ability?
Yeah, absolutely. And I think we've seen it just in this transition period. Mar-a-Lago is a very busy place right now, and not just with CEOs from the tech industry. You see Washington basically flying down to Mar-a-Lago. He has been entertaining members of Congress, senators, entire caucuses and factions of the House of Representatives. I think going forward, especially within this first 6 months, you're going to see a very hands-on White House, really working their agenda and working with the members within the House who might be the most difficult to get on board.
Jennifer, appreciate your time. Jennifer Flitton there of Invesco. Just to build on that last point, with regards to the tech sector, Mark Zuckerberg of Meta, in that podcast with Joe Rogan, took aim at the regulator on both sides of the Atlantic, particularly the Europeans, but talked about the United States and this administration giving them cover to go after them in places like Europe. It is intriguing to me that at the inauguration, you will see Zuckerberg, you will see Bezos, you will see Musk. And I wonder how this story is going to change and how much you're going to see the incoming administration support these national champions and then go after the European regulators that have been punishing them over the past few years.
Well, I think that's why you see Zuckerberg making these trips down to Mar-a-Lago, making sure he has a friend in the White House because of things like what he would call overregulation in Europe. They're not just showing up. Tara Palmieri reporting this morning that Zuckerberg is actually going to be hosting an inaugural ball reception for Trump and J.D. Vance with Miriam Eldison and some others. This is not just someone who's, I'm going to show up and quote unquote kiss the ring. I'm actually going to celebrate this.
Goldman numbers showing up, just getting them right now. Fourth quarter net revenue, 13.87 billion. The estimate, 12.37 billion. FIC coming in a little something like this. Let's look at how trading's been doing over at Goldman. Sales and trading revenue, 2.74. The estimate, 2.44. This is a cleaner read on capital markets activity. The stock is up in a pre-market by 3%. Danny, looking at the first read, it's a good read.
It's good, and it continues to be the trading bonanza. FIC coming in really strong, just like it did at JP Morgan. I'm going to be really interested in the look forward, though. What net interest income looks like, what they see for things like M&A with the new administration coming in.
So far, so good on Wall Street. Numbers from JP Morgan, decent. From Wells Fargo as well. And again, first look from Goldman too. Up next on the program, we'll get some more analysis from Ken Leon of CFRA. And looking ahead to US inflation data, Greg Peters of PGIM from New York City. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta. And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
60 minutes away from US inflation data, 2 hours away from the opening bell, and equities with a little bit of a lift. We are higher this morning across the board, up by 1/3 on the S&P 500. Similar move on the Nasdaq as well. Moments ago, we had numbers from Goldman Sachs, and Manus Cranny, those numbers are pretty good.
They are indeed, Jonathan. I think it carries through with this flex in FICC that you saw, first of all, in JP Morgan. Within Goldman Sachs, FICC comes in at $2.74 billion. That's quite significantly ahead of what was slated in the estimates at 2.44. On the investment bank as well, and if you think about the deregulation, the trough in investment banking that your guests have talked about this morning, this sets us up well for 2025. Investment banking, 2.06 billion. The estimate on the slate was 2 billion, but the fourth quarter comes in overall at 13.87. So it looks in this set of numbers, and you'll talk more about this with Shanali in a moment, it looks like the trading side on the equities in this story was a little bit stronger than the market had anticipated. Yes, still strong within the actual rates division. One small point here, Jonathan, that I would point out is on the advisory, fourth quarter advisory, 960 million. The market was looking for a number of over $1 billion. But then, of course, if you are at the trough and the nadir in terms of IPO and capital markets business for last year, and the upswing is coming, then that's probably not much of a spoiler effect in these numbers. But fourth quarter net revenue, $13.87 billion. And the estimate on the street was 12.37. Flex and muscle for FICC across Wall Street.
Yeah, they're flexing hard, that's for sure. This morning, Manus, thank you. On the advisory story, of course, the hopes is that's going to change big time through the next 12 months, particularly under the incoming administration. I almost laughed, Shanali, when I read out that number. Fourth quarter revenue, 13.87 billion against an estimate of 12.37. That's pretty stunning.
It's a lot of money. And when you think about the equities trading side in particular, what's more stunning is they brought in $1 billion. I'm laughing. They brought in $1.5 billion more than Wall Street expected. JP Morgan came in light. That means they are gaining share. Part of this is coming from the way that they are financing. They have record financing fees and record equities fees here. Goldman is going back to being Goldman. They are beating at trading, in particular investment banking. No one's going to cry about being just under $1 billion, right? They are expecting that deal rebound and that underwriting rebound. You might have noticed they had created a new unit this week called Capital Solutions. That is telling the street that they are going to be on their front foot and make sure that their clients can go out and borrow as much as they'd like. So they are working on that underwriting, whether it's traditional way underwriting or whether it's through private markets.
A profit that doubles is really just stunning, Shanali, and so much of the strength coming already from an increase in M&A transactions, even before the expected boom we're going to see next year. How does this year, forgot what year we're in, how does this set us up for 2025?
You know, what's interesting to me is a couple days ago, I spoke to Goldman's co-head of M&A globally, and he said he's cautious still. And of course, there's still higher interest rates. They expect growth to be above 10%, 12, 15% maybe when it comes to M&A markets. So yes, a rebound, but still private equity hasn't really come back yet. That's going to be about valuations. That's going to be about the cost of financing. Interesting here, just for the Goldman story in particular, they are so close. They are just shy of their medium-term targets. So when it comes to return on equity and when it comes to what they're able to return in terms of profits, that's going to be the big question. Can they get sustainably over that 13, 14%?
Shirley, how much are all these bank earnings colored by politics, whether it's the volatility going into the election, out of the election, and then just the hopes and dreams of this really light regulatory touch from the Trump administration?
If you think about just how much these banks have risen since the election, it's extraordinary. And Goldman,
double digits.
And in many parts of this market, you've seen Goldman shoot above its rivals because of that expectation. They have been #1 in M&A for years on the league table. So in theory, at least that part of the rebound should be best for Goldman Sachs. Now the rest of it, higher interest rates, you've been talking about this on the program a lot. If they stay that high, then doesn't it dent some activity? It was interesting to see JP Morgan come out this morning, not only raise net interest income expectations, part of that is because they think auto loans are coming back. Now, remember, with longer-term interest rates higher, mortgages don't get down below 7%. And so, but many of these big banks are already not really doing much of that anyways, right? That's going to affect the regionals much more.
They haven't been in the mortgage business in quite the same way for quite a while. You mentioned JP Morgan, the outlook was decent. Wells Fargo, the numbers were good. The trading numbers out of Goldman this morning, pretty stunning. Any weakness here whatsoever across these three banks?
I'm going to answer that with just a little more strength. Because the thing that's surprising me about the Goldman numbers and JP Morgan, Goldman's headcount rose by 3% while keeping expenses lower than expected. JP Morgan, in their statement, said that they will be investing in bankers and advisors across the country. They are hiring again. That is a story that we haven't seen for some time on Wall Street.
Goldman Sachs with some really, really stunning numbers across the board here, particularly overall net revenue beating by 13.87 billion against an estimate of 12.37, which is pretty stunning. The stock is up by 1.5% in the pre-market. Shanali will be with us again in about 25 minutes' time when numbers from Citi cross at 8 a.m. Eastern time. With us to discuss is Ken Leon of CFRA. Ken, 30 minutes ago, I asked you what's your favorite, what kind of business do you want to own, and you were loving Goldman Sachs. Do you love them a little bit more after those numbers?
We do, and I think there's a more dynamic story here for Goldman. They'll under-promise and over-deliver, I think, through most of 2025. The traditional businesses are going to get the benefits of positive trend. M&A, of course, with $1 trillion of private equity investments that have to be monetized in the next 24 months. CEO confidence is coming up. We're also seeing, with higher equity market values, great trading. But John, the story is, and if I was Goldman management, I'd be talking about their really pivot to having durable, recurring fee revenue businesses across. That would be an asset and wealth management. They're large businesses. And then also, as we see the easing of regulation in Washington, you're going to see Goldman be more of a principal actor besides just an agent for transactions. And what that means is getting to be more of a participant in direct private equity and private credit. We saw that as part of their announcement earlier in the week of blending some of these businesses so that they can partner or compete with Apollo, Ares, and others.
It is a different model, Ken, because for most of the big banks, the way that they've been approaching private credit is partnerships. Goldman, with that announcement, to your point, shows that they can compete with some of the big names. Which of the model for the banking sector do you think will ultimately win out?
Depends who you are, but I think Goldman can play offense. So they can certainly, as I said, be principal and compete, but also for asset-backed loans, they can also be there to also provide funding for the private equity firms. The traditional banks have a different game, particularly regionals or mid-size, which is really loans or syndicate loans competing against a corporate who wants to just get immediate attention with a direct borrowing from a private equity firm. And it's a sea change because it's moving up in size of the deals from small mid-sized companies to much larger deals over $1 billion. So it's a multi-year trend. I think Goldman, again, you have to go back over 10 years. Goldman couldn't be competing with Blackstone and KKR because of regulation. And we're going to see a little easing of regulation, but they're going to be smart because they want to have the right strategy and execute.
Ken, I want to go back to John's earlier point to Shanali. Do you see any weakness in any of these earnings?
The weakness is really related to any sharp change or shock in the markets that affects volume, but also affects in their books exposure. And I mentioned it at the hour before, which is really the black swan event. Some complex derivative product that has a ripple effect, whether it happens in Asia or Europe, but it impacts Goldman. Generally, the other one, which Jamie Dimon speaks to, is a geopolitical event. That has usually been, if there's any sell-off, a buying opportunity. But what we're seeing so far is confirmation that 2025 stayed the course, and we're going to see, I think, the consensus or street analysts raise their estimates as we go through the year.
It's the prudent thing to do to manage potential risk, Ken, but ultimately, I think what speaks louder than anything is the outlook from JP Morgan. The outlook's pretty decent. Geopolitics aside, incoming policy changes aside, the outlook's better than good, and the stock is up in a pre-market. I just want to finish with you, Ken, and look ahead to Citi. Numbers drop in about 21 minutes. You've had a decent read on a cross-section of Wall Street now. We've had numbers from Wells, from JP Morgan and Goldman. What should we expect from Citi in 20 minutes?
There's two things. First, they have the highest percentage of net interest income, over 70% of total net revenue. So we want to make sure there's a good print there. Second, from Jane Fraser, the CEO, is the ability to show that they're moving through on the transformation or restructuring, and we're actually seeing concrete evidence in the results.
Ken, appreciate your time. You'll be with us a little bit later. Ken Leon there of CFRA on some of the financials and the earnings we've had so far this morning. Shonali, just to cross over to you. When do these calls start, and what questions have you got?
Well, JP Morgan has an analyst call first, or a media call. They talk to us first. I do want to know where they think the rubber will hit the road. Not only is Ken right with that black swan event, I can tell you from firsthand knowledge, I'm still talking to all of these executives about risks, and more risks. We were talking about how JP Morgan, they increased their value at risk for the equities book while their book had missed expectations. They took on more risk, bought in less revenue than expected over there. At equity markets, still pretty close to all-time highs. And then they were beat by Goldman in that same business. So there is still a lot of competition going on, and the banks want to scrape every dollar out of their balance sheet to make sure they're capturing that share.
Bank stocks up across the board. Equity futures elevated on the S&P as well. We're higher by 1/3 on the S&P. As I say, numbers from Citi in about 20 minutes' time. With an update on stories elsewhere with your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Recapping those earnings, we're seeing a strong start to bank reporting season due to a trading bonanza. As Danny said, JP Morgan traders scoring their biggest fourth quarter haul ever. Meanwhile, Wells Fargo net interest income beat estimates, and it forecasts an increase for 2025. And at Goldman Sachs, earnings per share handily beating estimates, coming in at $11.95 per share, much higher than the $8.35 expected. Meanwhile, Donald Trump says he will create an external revenue service to collect tariffs on foreign imports. In a post on Truth Social, the president-elect says he'll set up the agency as soon as he takes office next week. Democrats and analysts have pointed out tariffs are already collected by U.S. Customs and Border Protection. And Meta is cutting roughly 5% of its staff. In a note to staff seen by Bloomberg, CEO Mark Zuckerberg says he's raising the bar and plans to, quote, move out low performers faster. Given its current staff, the move could affect roughly 3,600 jobs. Affected workers in the U.S. will be notified on February 10th, while workers in other countries will be informed at a later date. Meanwhile, new hires to fill those roles will take place later this year. That's your Bloomberg Brief. John?
Yahara, appreciate it. Thank you. More from Yahara in about 30 minutes' time. Changes at Meta, seeing changes elsewhere. On the labour front, reports of JP Morgan saying get back to the office 5 times a week. Neil Dutta of Renmax saying these are not things that happen when the labour market is super, super tight.
It's not just them. It's also Citi saying they're capping 401k payments. Microsoft pausing hiring in their U.S. consulting unit. Southwest Air halting corporate hiring. It's happening in a lot of different industries, which presents this idea that the labor market's maybe not as strong as it seems on the surface.
Neil's not a worrier. I want to be clear about that. He really isn't. He is no perma-bear. He is usually constructive. He has some concerns about how this economy is going to start the year and finish it in 2025. Up next on the program, U.S. bond traders hoping for some relief.
We've seen a little bit of a relief rally in the bond market because the bond market really needed it. But we got to see some sort of improvement in CPI as well for the bond market to really start to see yields push a little bit lower.
That conversation up next. Live from New York City, you're watching Bloomberg Surveillance.
You missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Stocks on the S&P 500, equities looking good, up by 0.4%. The bank earnings so far, so good. Numbers from JP Morgan, solid outlook from Wells Fargo, decent numbers from Goldman. Really, really strong on the trading side of the business. That stock is up in a pre-market. Next up for the bank earnings, we'll hear from Citi in about 15 minutes' time. Under surveillance this morning, US bond traders hoping for some relief.
We've seen a little bit of a relief rally in the bond market because the bond market really needed it. But we got to see some sort of improvement in CPI as well for the bond market to really start to see yields push a little bit lower. What's really affecting the 10-year portion of the curve is supply, the concern about Treasury supply, not just because of future deficits, but because of prior deficits.
Here's the latest this morning. US bond yields moving lower ahead of the December CPI report due out in less than 1 hour. Greg Peters of PGIM writing, quarter-to-quarter fluctuations notwithstanding, odds favour, on balance, stable to lower yields ahead, which bodes well for fixed income returns, whether they come from carry or from total return. Greg is with us in the studio. Greg, good to see you.
Great to be here.
Good morning, sir. Thanks for being with us. Let's talk about this backup in bond yields. What's behind it? What do you think is driving it? We just heard from a guest there, Tom Tesouris from Strategas, who thinks that a lot of it's about supply. Do you think it is?
That's a piece of it. There's a multitude of factors, honestly, right? You have, it's part growth, right? If you look at the move, it's mostly been real yields, right? So that's a growth change, which I don't quite fully comprehend. Some of it is productivity through AI and some other means. Some of it is supply through the deficit. Some of it is the policy uncertainty and factoring a little more inflation. So it's a combination of all those things, and kind of what's driving the move ultimately is the change in Fed. If you look at the pricing and probability of rate cuts and rate hikes, it's completely flipped. If you go back to September, the probability of a rate hike was virtually zero. Now it's almost 25%. So the fact that the front end is being repriced, that's allowing kind of yields to move higher across the curve. And this is a global phenomenon. That's the interesting part about it. It's not a U.S. story, it's a global story.
And we see it playing out worldwide, not just stateside. So if that's why you think yields are high, what gives you the confidence they're coming back down?
I just think it's a little far afield. Thinking about, we have CPI today and just inflation generally. I just don't really see the prospects of a rate hike here over the near term. What I think on balance, we're still in restrictive territory. I think ultimately the Fed, in this case, wants to get to neutral, which is a starting point of 4, and I just see kind of scope for that to move lower. And it just feels like a little overdone here.
But you pointed to the shift in the Fed, and I think that's a good point, because at the end of last year, you had a Fed that was guiding the market to a certain destination. What feels like it's changed is that we're back to a reactive Fed, a Fed that's very data point dependent. Does that not concern you? And what you're describing is that ability to get back down to a guiding Fed that's going somewhere lower.
I actually wish it was a data-driven market. It's the exact opposite. It's a potential policy-driven market, right? And if you're the Fed, how do you incorporate, tariffs, immigration, tax cuts, and deregulation? Some would bode for rate cuts. One would be actually hikes. So it's we're really beholden to policy here, which is not a great place from an investing standpoint, because investors ultimately like the data and want the data, and we're beholden to these factors that we don't really fully understand.
Well, then what happens if we have, for this year and the next 4 years, a Trump that is unpredictable in his policy, as we know he likes to be? What does that mean, not just for the Fed, but for markets that want that certainty? And a lot of market participants, let's be honest, who believe that they will get some form of it after next week.
Yeah, I'm surprised by that. To me, it's interesting. Investors seem to be amplifying the potential positives, which are, tax cuts, reforms, and deregulation, and completely dismissing the negatives, right, of tariffs and the impact of immigration. So to me, it's very much of a trust me trade, particularly as we enter next week, because the items that are more market negative are immediate, right, and they don't require congressional approval or involvement. The items that are actually more impactful from a positive standpoint from the market require Congress and other items, and that's going to be harder and it's going to take longer. And so we're going to be in this vacuum, I think, where the negativity is up front and we're waiting for the positivity. And I'm surprised that the markets are taking it so well. My suspicion is that the markets will continue to be quite volatile as a result, though.
Jamie Dimon leaned into these two risks, one being geopolitical, the other being what happens on the fiscal front. And he talks about inflation basically persist for some time. Do you foresee that under a Trump administration?
I do. Everywhere I look, I see more inflation, not less inflation. And so even though the CPI print is important today, it almost misses the point, because so much policy is on the come and changing, that's potentially inflationary. But you look at onshoring, nearshoring, friendshoring, that's all inflationary. You look at tariffs, it's inflationary. You just look at kind of the growth dynamics, it's inflationary. You look at immigration policy becoming more restrictive, it's inflationary. So I'm with Jamie on this one. I think we're out of the zone of disinflation, and I think inflation will be stable to, if anything, slightly higher.
The Fed would talk about inflation trending down. They want to get at a 2% target. How far off are we from that?
I don't see 2% anytime soon, honestly. It's important to remember that 2% is a made-up number, though, right? So there's no magic around that 2%, but my strong suspicion is that we'll be above that 2% for quite some time. And that's okay, actually, right? If it comes with growth, the challenge is if you have this stagflationary type of backdrop, that's the one that we really worry about for bond investors and just kind of investors broadly.
We spoke to your old protege, Andrew Sheets of Morgan Stanley, a little bit earlier this morning. We talked to him about how strong corporate balance sheets were and whether they could handle this environment. If you are expecting a more inflationary environment or sticky inflation, do you think corporations have the power to pass on price hikes in the way that they did a couple of years ago?
Well, it's been really surprising. Margins have been really sticky on the high side. So I've been calling for margin decline for, I think, 7 years or so now. And, I'm still waiting. But I think on the margin, you will see, no pun intended, you will see it come down. But the pricing power is actually quite strong, quite real. My suspicion there is that some of it will be absorbed through margins, but a lot of it will be passed on to consumers. And then consumers also have the option of moving away from those products into cheaper products, and that's what we saw in the tariffs last time.
This is going to keep interest rates higher for longer than we certainly expected. A phrase that we mentioned earlier on the program was survive until 25. There were certain companies that were trying to survive until 25. Fed was going to cut rates, things would be okay. Doesn't look like they are anytime soon. Who's in trouble? Which parts of fixed income wouldn't you touch right now with that in mind?
The challenge that I find is that valuations are priced for perfection. So I look at credit as an example. I think the credit markets are in pretty good shape fundamentally, as Andrew mentioned. Balance sheets are strong, cash flows are high. You have parts of leverage in the system for sure, but it points to a strong macro. My challenge is that it's priced that way and then some. And so I look at the fixed income markets, I look at the equity markets, and the concern I have is that we're pricing in this productivity miracle, which is down the road, on the come for sure, and the immediacy of that impact is, I think, quite disappointing.
What it sounds like, and you could correct me if this is the wrong interpretation, you seem to have more relative confidence in treasuries right now than you do in corporate credit. Is that fair? Is that the wrong interpretation?
I slightly agree with that, I guess, in a way. So
I'm running with it.
That's why I'm here. But my concern is that the credit spread that you get, it just negatively convex, right? So if in fact you are wrong around the economy, then that benefit really goes away, right? So the extra spread that you're getting, which is quite paltry, it's like the richest decile that we've seen over the past 30 years. You're just not really getting paid for that risk. So yeah, all else equal, I'd rather have duration risk in my portfolio because it provides that ballast, that balance. If things do go pear-shaped economically, you have that duration. If you have that duration in credit, you're fighting kind of the weakness in the economy through the credit spreads, and you're not getting that duration benefit.
Smart. It's always good to see you, particularly in person. Thank you, sir. Greg Pittis there of PGIM Fixed Income. On fixed income, looking ahead to US CPI inflation data 34 minutes away. In about 4 minutes' time, we also get numbers from Citigroup, so look out for that. We'll be catching up with Peter Cheer of Academy, David Kelly of JP Morgan Asset Management, and Aditya Bave of Bank of America Global Research. From New York, the third hour of Bloomberg Surveillance is just around the corner.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture, it's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
We've had some reports on inflation and inflation expectations which weren't great. If that continues, that could cause the consumer to pull back.
With inflation sticky, growth strong, we just didn't see scope for the Fed to be cutting rates this year.
Inflation will be sticky. We'll basically be living with a high inflation target.
In our view, slowly but surely, it is heading close to 2%.
What we're seeing right now is the biggest catch-up in history between soft data and hard data.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
So we've got a lot to get through this hour. In 30 minutes' time, we get US inflation data, an absolutely stacked hour ahead of us. Before we get there, we need to talk about more banks. Equity futures, at the moment, elevated by 1/3% on the S&P. On the NASDAQ 100, up by 0.4. We've had numbers from JP Morgan. The outlook was good. Numbers from Wells Fargo, decent. Numbers from Goldman Sachs, the trading numbers, absolutely stellar. And just moments ago, numbers from Citi. With the latest, here's Manus Cranny.
Jonathan, it's a quartet of good news, and it's a triptych in FICC. Citi has delivered FICC sales and trading of $3.48 billion. The estimate was just under $3 billion at 2.94. So that just shows you, again, the musculature of FICC, the good vol that you had in that fourth quarter into the election and afterwards, post that jumbo rate cut from the Fed. Buyback, $20 billion. This was the missing piece in the chessboard, according to some of the analysts. It was a slight promise by the bank just before Christmas in terms of the narrative from there. Mark Mason hinted that this would be. So $20 billion in a buyback. FICC is a comfortable blowout. And investment banking revenue, $925 million. Again, this is what the market was hoping for, is that renaissance, that change that Jane Fraser has enacted across this bank would be rewarded. Investment banking, $925. The market was looking for $896. So that's a comfortable read for Jane Fraser at Citi this morning. Jonathan.
Manus Cranny, thank you. Citi up by 2.4% in the pre-market. Shanali Bassett with us around the table. Shanali, is that a clean sweep this morning? Decent across the board here?
The numbers themselves are very decent. You have them beating on fixed income and trading revenue. You have really strong results here in terms of net interest income as well, above expectations. What investors will also be looking at, John, though, remember, this is a bank that's in the middle of a turnaround story. They did lower their return on tangible common equity targets. The new target for 2026 is now expected to be between 10 and 11%. That used to be higher, between, let me tell you exactly, it used to be between 10 and 12%, I believe. Yes, 11 and 12%. So they are lowering that for next year. By comparison, Goldman is expected to be bringing up in the medium term above 14%. JP Morgan puts up 17% like it's no problem every quarter, right? So that is going to be the number for Citigroup that investors are going to be looking to, because really, with regulatory hurdles that Citi still faces, how can they keep their expenses in line to bring profitability up as they go through this turnaround story?
That I find interesting, that at least for the moment, we are able to get some decent of a rally, despite the fact that they lowered their return on tangible equity goal, because this had been such a big thing for them. Mike Mayo had said that he didn't think they'd get to their 12% target until 2027. Are moving the goalposts, is this something that investors will be okay with Jane Fraser, who is just so under pressure right now?
Listen, the answer is maybe, because at least you know where they're going now. They're giving you credible targets in terms of what they need to put out the door and what they're going to bring in the door, while, by the way, beating on expectations with the revenue they're bringing in. If they're bringing in revenue and they're showing that they're steadily beating, then maybe it's okay. The point that you made earlier, John, about Danny, you made it, about the models, the business models. They could take on less risk while they partner with private credit firms to bring money in the door and gain client share. They have a new head of investment banking. I think you guys are talking to him very, very soon as well. That will change the game for Citigroup. But remember, the other story for this, too, is they're the cheapest. You have JP Morgan and Goldman Sachs, each trading well above 2 times book value. Citigroup is still well below that. They've made progress, but they have a gap to close here, and investors are looking for them to do it.
Offering some headlines on the outlook here. Let me go through them, Shanali, just briefly. So for revenue for 2025, a range of 83.5 billion to 84.5. The estimate was 83.2. For net interest income, ex-markets, to grow in 2025 modestly. To your point, does that do enough to offset this morning, just rolling back the profit target just a little bit?
The modestly part is a little hard when JP Morgan an hour or two ago said that they're going to bring in $1 billion more in net interest income. They both have massive card businesses. When you hear Mark Mason, the CFO, talk to journalists shortly, but also both of them, Jane and Mark, will talk to analysts soon too. Do they see something different in terms of credit quality? Are they more cautious than their large rival, JP Morgan? Is part of this pressures internationally? Remember, Citigroup has that special concern that a lot of other banks don't have as much of. This is the question.
Shanali, appreciate your time this morning. Lots to work through. Look out for more from Shanali in about 55 minutes' time when she leads the show into the opening bell alongside Matt Miller and Katie Greifeld. Ken Leon of CFRA is still with us. Ken, we spoke to you about 30 minutes ago. I'm going to say this for you. You gave Goldman Sachs an A+. What does Citi get this morning?
Well, we'll give them a B. I haven't seen the details, but picking up from what Shanali said, the return on equity narrowing the range, they took a $1 billion restructuring charge in 24, so the ability possibly to reduce costs, or more than the street thinks, might be able to help them on ROE. Citi is also an event-driven stock of the large banks. They are finally, this year we hope, moving to monetizing, selling in Mexico, Banamex, which was by far the largest consumer bank they had outside the U.S. So that's significant. It's event-driven. They also have stable businesses with more transparency. That's called services. It's treasury and trade solutions, a dominant position in the corporate treasury market. And certainly they're more on the fixed income side versus equity across banking and trading. So I think Citi's going to be fine. And they're still trading below net tangible book value, although the gap has narrowed a bit. So we need to see results improve through 2025. But I think myself and most analysts with buys think that they can execute. Jane Fraser is still on course.
She's still on course. That gap maybe even narrowing more this morning with the rally still ongoing pre-market. Ken, another headline that came out is that they see their expenses for 2025 slightly lower than $53.8 billion. That is the high end of their range that they had already given to this market. Does it concern you that they aren't bringing in expenses quicker in the midst of this restructuring?
Well, it ties in with my earlier point, a $1 billion restructuring, but what they're doing is reducing management layers and also realigning businesses that weren't really responsive to the markets or customers. So I think it's a timing issue and one where you'll see accelerated improvement perhaps in the second half of the year, but you'll see improvement, but it just doesn't happen in 1 or 2 quarters.
Hey, Ken, appreciate your time. Thanks for this morning. Ken Leon there of CFRA on Citi. That stock is up by 3.6%. We've had numbers from JP Morgan, from Citi, from Goldman and Wells Fargo. Tomorrow, we'll hear from Bank of America and from Morgan Stanley. Equity futures this morning, more broadly, up just a little bit, going into a huge data point in about 20 minutes' time. Coming up this hour, we'll catch up with Peter Chair of Academy Securities, counting down to CPI, David Kelly of JP Morgan Asset Management on why he thinks inflation will slowly tick lower over 2025, and Aditya Bharve of Bank of America Global Research expecting the Fed to stay on hold all year. We begin this hour with stock steady. Investors are waiting CPI due out in just under 30 minutes' time. Peter Chair of Academy Securities weighing in on the month's data so far, saying this: what if markets reacted so poorly to payrolls because no one believes the data? But everyone believes that the Fed will need to react to the data. The Fed is forced to rely on official data, but the data isn't reflective of reality. Does that lead to policy mistakes? Peter joins us now for more. Pete, good morning to you, sir.
Good morning.
I love this quote over the weekend. I shared it with the audience as we kicked off the trading week. Are you suggesting the number we got on Friday overstates reality?
I do think so. And, you know, part of me, I just look, 75 economists submitted to the Bloomberg survey. 74 were under. Only 4 out of the 75 were over 200 jobs. So they missed by a lot. So either we have to believe the official data is so much better than all these smart people with their resources figured out, or the official data might be wrong. And certainly the trend for the last 2 years has been the data's been overstated, especially in January, February. So I think that's where we're in this awkward position. No one really trusts the data. The economy doesn't feel that strong, yet the Fed seems to be responding to that.
So good news with an asterisk is bad news?
I think so, if you don't believe it. Again, I think CPIs might play out the other way, where I think people are starting to believe CPI has been understated. And so as it starts catching back up, the Fed's going to have to react to that. So I think the Fed's caught themselves in this kind of quandary where they missed a lot of it. You go back even to CPI. They were talking about housing, and they missed housing on the way up because the official data took time to reflect what was going on in rent. They've been missing it on the way back down, but now it's all normalizing. So I think this is a big disconnect where everyone in the markets is trying to figure out what the economy really looks like. And then what's this data-dependent Fed going to do if they're relying on the official data, which people seem to question more and more?
Isn't this, though, a bit of hubris on the part of markets to suspect that they know the data better than the Fed does? Why would the market have a better insight into it than the Federal Reserve, than the FOMC? Would they not have some understanding that perhaps the data is skewed too?
So I would say maybe 10, 20 years ago, the BLS had more computers than everyone else, right? People have AI. People have access to all sorts of data, right? These economists are using AI. They're using all sorts of tools, whereas the BLS has a lot of rules they have to follow. So it's pretty prescribed, right? They chose, for example, to use COVID period in their seasonal adjustments. So kind of whenever I look at charts, I try and wipe out the COVID years because it was so much noise. So it's things like that that I think maybe people have taken some time, aren't bound by rules, or actually getting closer. And ADP, which should, in theory, probably have pretty good real-time data, came nowhere close to the official NFP either. So those are the questions I think everyone has to ask. Problem is, even if you had the exact right number, you're still going to have to trade off what the market comes up with.
How much noise is political uncertainty making?
I think a lot. I think, Greg Peters talked a little bit about this, even looking at bank earnings and everything kind of going forward. A lot could change in the next 2 months. So, we are sitting there watching. Part of it, I think we probably have a beat on CPI, so CPI comes in higher, partly because I think people have been buying things ahead of potential tariffs. So you're seeing demand pulled forward by these tariff fears, and we'll go through a lot of information in the coming weeks of what does Trump really want to do, what can he get done. In terms of tax cuts, I think people have been overplaying that a little bit. To me, just keeping the tax on isn't a tax cut, right? Everyone's not going to change their spending. Oh, no one that I know is thinking I'm going to have to pay higher taxes.
To be fair, though, it is a tax cut if I believe that 4 months ago someone else was going to win this election, and I thought taxes were going up.
That's fair. And I think if they get the SALT deduction, that would be a official tax cut. But I think people have been a little bit optimistic on these things.
You mentioned the bank earnings. I want to cross over to Shonali again and bring you back into the conversation because the media earnings call just kicked off with JP Morgan. And about an hour ago, we said that this call would be 1/3 on the numbers, 1/3 on the Trump administration, and 1/3 on succession. Jamie Dimon had this to say on the earnings call. Management changes in the last day don't change the succession timeline at all. Now, I'm not familiar with a timeline. Are you familiar with the timeline for succession at JP Morgan?
All I know is that he stopped saying 5 years. So there is no succession timeline. In fact, I love Mike Mayo's note about this. He goes, I'm confused on who the next successor is if Jen Pipsack takes herself out of the race.
Do you think we're getting closer to the point where it becomes a problem? Because this is an individual widely celebrated by Wall Street. It doesn't appear to be a problem for the stock. It's trading near a record high. How close are we to this becoming an issue?
You know, speaking of inflation, you know what I love about Wall Street? We're in the second week of January. Goldman Sachs already, JP Morgan, and now you're seeing changes at BlackRock as well. People out the door and people up the ranks. And so you better give them another title if you can't pay them much, much more right now, because right now people are asking for more. And yeah, you have to keep the next generation happy if they can't rise as high as the CEO spot.
That earnings media call just underway. Any more headlines, we'll bring them to you. Shonali, thanks again for this morning. Peter Cheer's going to be sticking with us. Going through to CPI, inflation data is about 17 minutes away. Equity futures into that higher by 1/3 on the S&P. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Staying on those banks' earnings season on Wall Street, kicking off on a high note. JP Morgan traders scoring their biggest fourth quarter haul ever, while Wells Fargo net interest income beat estimates, and it forecasts an increase for 2025. At Goldman Sachs, earnings per share came in at $11.95 per share, much higher than the $8.35 forecast. And Citi, rounding out bank earnings for the day, posting markets revenue that beat estimates and announcing a $20 billion stock buyback. Shares are up 3.8% in the pre-market. Meanwhile, Southern California faced another night of extremely critical fire conditions due to high winds and minimal humidity, leaving 10 million people at risk. The fires have already claimed the lives of at least 24 people and have burned down more than 12,000 buildings, including many homes. And the Washington Post reporting Elon Musk will be joined by Jeff Bezos and Mark Zuckerberg at President-elect Donald Trump's inauguration on Monday. The three tech moguls will sit on the dais alongside former presidents, Trump's family, cabinet picks, and lawmakers. That's according to a Trump official who spoke to the paper on the condition of anonymity. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next 30 minutes or so. Up next, the morning calls. And later, David Kelly of JP Morgan Asset Management and Aditya Bhavev, Bank of America, reacting to CPI. Aditya and the team over at BofA more recently dropping their call for any rate cuts in 2025. That debate is just around the corner. From New York, this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
So this is the setup going into CPI in just a moment. Inflation data just around a corner, and equity futures at the moment up by 1/3%. In the bond market, things calm down a little bit. Yields are lower by 3 basis points. The 10-year 475.75, and I should stress this can all change in about 10 minutes' time. Time now for some morning calls. First up, Bank of America cutting its price target on BlackRock to $11.94, citing declining month-over-month net flows. That stock is still positive by 3.2%. Your second call from JP Morgan raising its price target on Deere to $4.70, saying it's in a good place to hide if the macro narrative turns worse. That stock is up by 0.1%. And finally, Barclays raising its price target on Tesla to $3.25, saying its narrative command has gone into hyperdrive since the US elections. That stock is up by another 0.75%. With inflation data just around the corner and inauguration 5 days away, Peter Chi of Academy Securities is still with us. Pete, let's start there. Inauguration, that is for many people the most important data point of the month. What kind of changes are you expecting on day one?
So I think markets might be a little complacent on the tariff side. I do think he's going to start off slow, but from people who worked with Trump under the past administration, he really does feel that Xi did not live up to his promise to buy U.S. ag goods. So I think there's a degree of caution with Trump and a lack of trust with him towards Xi that I think may yet play out. So I think we're going to see a little bit more bumpiness from the tariffs. So I think that's probably a negative. I think on the immigration side, I'm fairly comfortable Trump's going to go more for what we're calling easy wins. Pick and identify targets. Maybe it's something like the Roosevelt Hotel that's kind of grown on to a life of its own, the criminal organizations in some of these cities, and kind of this law and order. So we don't see this devolving into some sort of door kicking, pulling people out of restaurants. I think he's been told by the Chamber of Commerce, by a lot of small business people, leave the good migrants alone. Let them work. So go some high-profile wins. So I don't think that's going to be too disruptive. And I think we actually see some good news on the geopolitical front. I think Iran is back on the heels. Israel's prosecuted the war so well that we, from a military standpoint, that they've knocked them back. And so we think there's a possibility there. And the rest of the Middle East is really trying to move on to westernize their economy. And I think there's a decent chance he pulls off some sort of negotiated settlement with Russia and Ukraine.
So 3 topics there. One was trade, the other immigration, and finally on geopolitics. Can I just go to trade first of all? Whose approach do you think that the incoming president is going to run with? Is this going to be the Treasury Secretary designate Scott Bessent, incrementally negotiate, 2 here, 5 there, month on month? What kind of approach are you expecting?
I think he's going to start that. And again, part of this depends how many easy wins he gets, right? If he wins on some immigration issues early on, maybe he can afford to be that. If he feels like he's not getting on immigration, then he'll go for a bigger, more aggressive play on that. One thing we've been watching very closely is his change on TikTok, right? So to me, TikTok was very interesting because you had bipartisan agreement that China had to sell, and Trump seems to be walking that back a little bit. So to the extent we all thought there was going to be this real degree of friction between Trump and China, it's a little bit concerning to me that he's all of a sudden, oh, TikTok might be okay, and you can't tell whether he likes TikTok because TikTok's good for him, or whether he's just not concerned, or whether he hasn't been read the riot act once national security truly gets into him.
Well, speaking of TikTok, they're making a huge splash this weekend, potentially just pulling the plug according to the information on Sunday. How much is TikTok now potentially a negotiating tool for the Chinese, based off our reporting that they're willing to hand over the reins if it's Elon Musk and handpicked who could basically take on this company with Trump's trade negotiations?
And I think that was an interesting play by them because of all people, I think Elon Musk has been great, but do you want him having control of yet another media outlet? So I think they're throwing kind of a wrench in this, right? It's if you didn't own Twitter or X,
issues.
Right? So it's kind of interesting. That's where we're really watching. I think in the end we start seeing more pressure on China. That once he becomes president, once he's kind of fully every single day forced to listen to national security people, I think we redevelop that friction. and the things that Biden's been doing this last few weeks in terms of, chips, I think that just continues. I think there's going to be real high-tech pressure with us in China. I don't think that's getting better. I think our economies are continuing to drift apart, and we might get some short-term deals that let that work, but I think longer term, China's trying to work with the autocratic, resource-rich nations. They're trying to sell their brands there, and we're separating from them. We're going to have to figure it out, and we're going to bring a lot of things home, and we're going to do a lot of, not just drill, baby, drill, but I think it hasn't caught on refine, baby, refine, but we're going to do a lot more extraction of resources and the processing, because China still processes over 90% of the world's rare earths and critical minerals. We have to have a decent subset of that done domestically or close friends.
As we get some of this coming in, as we get the various headlines of him going after China, of the tariffs he's going to put on, how do you understand the market's ability to actually react and absorb it? Because to your point, at the moment they haven't. It's a market that's been interpreting things as positive. It looks at 2 to 5% incremental increases in tariffs and says that's a good thing. Is this a market that just will continue to discount any of the negativity?
Well, the bond market's certainly been looking a bit the other way. The bond market's been going worse every day. They're looking at some of these things. We're seeing inflation everywhere. Equities have been a little bit disjointed from that. You are starting to see some of the value come through. I think it's going to be a great year to be an investment bank, because I think you are going to get increased volatility in bonds and equities. And, again, I always view that Trump likes to create noise. Our theme of 2025 is it's going to be messy. Anytime you think things are going to be really good and smooth, expect some noise the other way. And every time you think it's going to be this disaster, expect some reassuring comments. So that's how we're trying to trade this. It's still hard, but it's just expect Trump to do the unexpected, if that makes any sense.
What's your favorite investment idea off the back of all this?
Right now, I do like anything that's going to be part of this refining process or processing. So I think a lot of the big equipment manufacturers, and it's almost scared to say, but I do like a overweight in commercial real estate. I think commercial real estate is going to be one of the big beneficiaries of this whole year.
What kind of commercial real estate?
I think office, big cities is fine. I think the work from home is almost done. I think by the end of this year, we're going to be 4.5 days, which means maybe you get every second Friday work from home. There's this huge push, and what I like to see is kind of, again, we mentioned earlier, this return to law and order. Okay, shoplifting is now a crime that's being punished again. Sure. You've seen Mayor Adams change a lot. I think various cities are looking at this various ways, but I think you start rebuilding that downtown core. To me, it's still half insane that every federal employee is still work from home. Musk will change that. Watch for resurgence in downtown D.C. as, yes, there will be some job losses, but those buildings will start filling up. The bottom floors will start reopening with the Starbucks and all the other stores that go in there.
So you see a net positive from that call?
I do. I think it's going to be, this is, in 2 years, we're going to kind of forget a lot of this work from, home type thing. And again, I think it's even coming with younger employees. They want to be mentored. They're realizing this is hard to have career growth if I'm not in the office.
This is a big vibe shift that we're seeing in corporate America. We're seeing this across various companies right now. Do you think it's ending virtue signaling or replacing it with a different kind of virtue signaling, or actually getting back to core competency? How do you see it?
I think for the last 2 years, every CEO was banging on the table wanting people, and he was being told by HR, you can't do that. People will quit. People won't. And as it starts fulfilling, I think this has just been pent up. No one's wanted to no CEO or very few CEOs have wanted this to go on. Yeah. I think San Fran's going to be a slightly different area, only because those companies in and around there they benefit from the work from home. So I'm not sure they're going to push people to the office. I think San Fran still has not yet cracked down on crime, so that's going to be an issue, so maybe you want there. I'm a little bit worried because I think on rates, we're not going to get as much help from commercial real estate, and some of the properties still probably need to be revalued, but I think that's going to be the big surprise is everyone pushes for this work from office. You start seeing things rebuild. You see around here, the bottom floors start reopening, stores in there, places to eat. I'm excited for that.
Anne-Marie said it last week. 2 CEOs. One's the head of HR. The other one's the actual CEO.
And I think in 2025, the HR CEO is going to be in the back of the bus.
Taking a long vacation, working from home, maybe. Who knows? Not hours, love hours. Peter Chair of Academy. Don't want to cross them.
Be careful.
Don't want to cross them. Appreciate it, Pete. Thank you. Inflation data up next. Danny, stay out of it. Equities up on the S&P. Smart thing to do. Up by 0.4% on the S&P 500. Inflation data up next.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
So here it comes, the big data point of the week. US inflation data just around the corner, 20 seconds away. Going into it, your scores look like this in the equity market. Futures positive by 0.4%. On the Nasdaq 100, up by a similar amount, up by 0.37. In the bond market, after 8 consecutive days, an 8-day run of yields not dropping on a 10-year, they are dropping this morning by 5 basis points. Your yield, 474.93. Your economic data looks like this. It's Mike McKee. Good morning, Mike.
Good morning. Well, it looked like economists have done their job again because we're coming in almost bang on the numbers with the CPI up 0.4 during the month of December. That's a tick higher than in November, and it is right on with the consensus. On a year-over-year basis, puts us at 2.9%, up 0.2 from November. The core is up 0.2. That's a little bit less than last month, which is some good news for the Fed there. 3.2% on a year-over-year basis. That's down from 3.3% the month before. So overall, some reasonably decent news there. Let's take a look quickly here at some of the biggest numbers that we normally get in these things. We see gasoline prices down, or rather up by 4.4%. We saw that impact in the PPI as well. New vehicles up 0.5%, used cars up 1.2%. That's a little bit lower than the 2% last month, but still not great news. Apparel up only 0.1%. And the one number that everybody always wants to see, of course, is owner's equivalent rent. What are we doing in terms of the overall housing market? And owner's equivalent rent is up by is up by 0.3. That's a tick higher than last month. So maybe some of the progress goes away. I'll let you see what's happening in the markets, and we can come back with more in terms of categories.
Look forward to it. Stay close, Mike. Thanks for that. This market's trading on core CPI, coming in just a bit softer than expected at 0.2% month over month, excluding food and energy. The estimate was 0.3%. And the move looks like this. Check this out. Talked about this yesterday when we got PPI and the downside surprise there. This market is so jittery around inflation. You get any sign that things are a little bit better than expected, we're off to the races. Equities up by more than 1 full percentage point on the S&P, on the Nasdaq up by 1.3, on a Russell, the small caps up by 1.8. Check out the bond market. Yields dropping at the front end of the curve by 7 basis points, down 8 on 10s. That unlocks a bit more dollar weakness. Euro dollar back through 103, 103.45. And I'm thinking of you, the UK. I'm always thinking of you in the UK. Gilt yields a whole lot lower. Inflation surprised to the downside in the UK a little bit early this morning. And no doubt, Danny, this move stateside just takes a little bit of pressure off foreign authorities as well. In the gilt market, 10-year yields are now down by close to 14 basis points.
Well, to your point, they were already rallying because of that better CPI number, as in weaker CPI number coming from the UK. But the rally is taking on a new life of its own. These numbers are so important. It is not just the UK. It is a lot of the UK. It is also Japan. It is a BOJ that seems like it wants to hike, but in order to do that, it needs to have inflation, at least these kinds of figures coming in. It needs to have a Fed that isn't hiking rates. You can see that now, the yen up more than 1%. So many different markets internationally, be it EM, UK, and Japan, we're waiting on these numbers, and they will have big consequences for their central banks.
David Kelly's with us around the table. David Kelly of JP Morgan Asset Management. David, good morning. Good to see you.
Good morning.
You expected to see more of this, softer inflation prints in the months ahead?
Yes, I do. I think it's important to recognize that the year over year, which is kind of high right now at 2.9, that's going to look a lot better by April, because the first 4 months of last year, we saw pretty strong inflation. So that makes it very easy to get down to a low twos by April. And overall, this is not an inflation-prone economy. I mean, the economy left to itself is just chugging along, steady growth, a little over 2% growth, unemployment very steady, and inflation gradually coming down. So, the economy itself looks pretty good right now. It's got a lot coming up on the plate here, but overall, feel pretty good about inflation.
We'll talk about what's coming up on the plate, and I assume you're talking about incoming policy changes potentially. You've written about this, sources of inflation, labor, energy, goods, and services. Where do you have the most confidence now?
I think the most important is the labor market, and I think what we've seen is American workers just won't ask for a raise. It's remarkable. I mean, we saw production non-supervisory workers' wages up 3.8% year over year. We've got 8 million job openings. Everybody knows it's hard to find a good employee, but yet quits rates are below where they were before the pandemic. And either American business is great at saying why they're not going to give people a raise, or American workers are just wimpy about asking for one. But whatever way it works, we're just not getting inflation coming out of the labor market. And without that, you cannot get sustained inflation.
Just to that point on the labor market, as we're digesting CPI, you have had these individual announcements from companies, be it from Meta, Microsoft, Southwest, Citi when it comes to benefits, about reducing hiring, not hiring, or even letting people go. Does some of that softness, do you look at that and say these are idiosyncratic company events, or does it suggest that something has indeed shifted in the labor market in terms of who has the power and overall represents some form of softness?
No, I think it's good messaging from these companies. There's nothing like announcing prospective layoffs to quieten down the labor force. So I think it's a way of really suppressing wage gains. There's no evidence in GDP. I mean, if you want to figure out where employment's going, look at where GDP has been, because the last 4 quarters, the current quarter and the previous 3 quarters, are a very good driver of payroll employment. So I know that the rate of growth of this economy is capable of generating 150 to 175,000 jobs per month as an average through this year. And that forecast is good for at least the next 3 to 6 months anyway. So there really isn't any softness in terms of the overall economy, but businesses, they focus on margins, they focus on efficiencies, how can we be more productive? And yes, if that means announcing, well, we're going to have to lay off a few people, then that actually works in terms of maintaining cost control.
David, John mentioned energy, and that was a big part of this inflation story for this print, 40%, I believe.
Yeah.
IEA overnight was saying actually they see a smaller glut next year. How concerned are you that fighting energy prices, higher oil prices, higher gasoline prices is going to be a concern for 2025?
Not too much. I mean, if you look at the global composite PMI index, you've got a global economy that is kind of muddling forward. The US is doing very well. Places like India and Italy are doing well, but a lot of Europe and particularly China are pretty soft here. That's not going to generate a lot of demand. Meanwhile, I think with the change in administration, you could get 2 things. One, you may get a peace settlement in the Middle East, which could dampen down tensions a little bit and concerns. And then secondly, you're going to have a very pro-drilling policy, which could increase U.S. production, and some deregulation, which could help the energy sector. So overall, I don't think energy prices for fossil fuels are likely to go up significantly over the next few years.
If you are just joining us, welcome to the program. 7 minutes ago, inflation data dropped and came in a little bit better than expected on core CPI, excluding food and energy, month over month, coming in at 0.2%. The median estimate in our survey was 0.3. On headline inline at 0.4%, the estimate was 0.4. Of course, we're trading off the back of that downside surprise on core CPI, and it's unlocking much lower bond yields across the curve. The 10-year is now lower by 10 basis points, the 2-year down by 9. That unlocks some dollar weakness and euro strength, euro dollar at 103.40, and equities, a really big lift to stocks. On the S&P, up by 1.4%. Likewise on the NASDAQ, and on the Russell, the small caps are absolutely flying this morning. On the Russell, we are rallying pretty hard going into the opening bell, up by 2.9%. David, you talked about the incoming administration. Danny talked about this earlier, the cost of not making your plans clear. You think it's high yields. Is that what's playing out in the bond market? Not this morning, but leading up to this move.
Oh, yeah. Yes, I absolutely, because we don't know how far we can push the global bond market. And on Friday, we're going to get some new numbers from the Congressional Budget Office looking at, if we don't do any tax cuts from here, if we don't even extend the tax cuts we've got, I think they'll still show the debt to GDP ratio rising to about 120 to 125% of GDP by 2035. It looks like the budget deficit for this year could come in at over $2 trillion, and half of that is interest. And these higher interest costs that we're seeing, it's a negative feedback loop because it's actually pushing up the deficit. And the question is, well, how much can the government borrow from global capital markets at very cheap rates?
You said in your note, the most dangerous 3 words in economics are, quote, wait and see.
Yep.
What do you do then in this environment where Trump wants to be unpredictable? That's part of the policy.
Yeah, and it doesn't, it works, it works well in football, it works well in military maneuvers, it does not work well in macroeconomic management. You actually have to let people know. I mean, that's why the Fed spends so much time saying, we're looking for 2% inflation, and just tries to, telegraph their punches all the time. And that's really what you should do in macroeconomic management. So, yes, I think there is an uncertainty tax. Absolutely, because the problem is that if you don't know what the administration is going to do in terms of taxation or deficits, you don't know where interest rates are going to be, what's the easiest thing for business to say? Well, let's wait and see. And when everybody decides to wait and see, what they eventually see is not good. So it actually drags on the economy, it slows down economic growth. So I am not concerned about the economy accelerating a lot this year at all. I'd be more worried about it decelerating if we have some shock or make some mistake.
To Anne-Marie's point, though, this president, the incoming president, values a lack of predictability.
Yeah.
Are you saying that's going to be a permanent feature of this bond market through this administration, a yield premium, because we just won't have a clear plan?
It could be, but also because we're going into uncharted territory in terms of how much we're trying to borrow from the, the biggest borrower in the world is going to be borrowing more than they've ever borrowed before. We're at a delicate point here because we really need to, not only do we have to have a sensible plan in terms of revenues and spending, but we need a certain amount of predictability. If we sort of push through a budget plan which suddenly pushes us to a $4 trillion deficit, and everybody says, oh, it's okay, we're going to grow our way out of it. We're not going to grow our way out of it. I mean, we have to do some sensible budgeting here. And yes, I do think that could push up long-term interest rates. And as I say, it's a feedback loop because that pushes the deficit to GDP ratio up to 7%, 8%. Those numbers make it very hard to finance this debt.
It's pretty a negative cycle. David, it's good to see you. As always, appreciate your time. David Kelly there of JP Morgan Asset Management. Inflation data, a downside surprise, the right kind of downside surprise on CPI, unlocking a big rally in this equity market and driving yields a whole lot lower in fixed income. Mike McKee's back with us with the details. Hey, Mike.
John, I think a lot of people care about the supercore all of a sudden again. The ex-housing number, that's gone down, up 4% on a year-over-year basis, but that is the second consecutive decline, and it is significantly off its highs as that continues to move. We mentioned housing up 0.3 for owner's equivalent rent. That's something people will keep an eye on because they want to see it keep going down. Motor vehicle insurance was up 0.2 after a 0.1 decline last month, so not progress there, but not bad. Airline fares are what's really going to catch a lot of people's eyes, up 3.7%. Remember, they were up about 8% in the PPI. And then just because we have to throw politics in for Anne-Marie, egg prices were up, but not all that much, just 3.2%. That's down from an 8.2% increase in November.
Mike, thanks for the coverage. Mike McKee there, driving things on the economic side of things. Joining us now to continue the conversation, Aditya Bave of Bank of America Global Research. Aditya, you made a call in the last week off the back of payrolls. No more rate cuts in 2025. Does this data point this morning change things on the margin at all for you and the team?
No, I don't think it changes our mind, really. It's a good number. 0.2% on the core PCE. We were below consensus at about 26 basis points. This was even softer than that. But what's different this month relative to previous months is that we already have the PPI data. So we can very quickly go from reacting to CPI to then doing the read-through to PCE, which is what really matters at the end of the day. And if you look over the last 3-4 months, we're basically running at around 2.5%, which is where the Fed thinks we'll be at the end of this year for the core PCE. So by the Fed's own admission, inflation is stuck around 2.5%, and then also on top of that, the labor market seems to have stabilized, and that was the primary reason they were cutting. So we don't see any reason for them to keep cutting now going forward.
Aditya, in that same call you made, you also said that should core PCE come in somewhere above 3%, then we'd start talking about hikes. With this data in hand, even if it doesn't change your call when it comes to no cuts, does it at least move us further away for having to talk about hikes?
I think that's fair. We were pretty upfront about the fact that the bar for hikes is still quite high. So getting to 3% is not a trivial thing, right? Even setting aside this latest data print, as your previous guest mentioned, we are going to go down on the year-over-year rate over the next 3 months, most likely, because the base effects are very favorable. So I won't be surprised if we're around 2.5% once we have the data through March. So to go from there to 3% is going to be very challenging, and it'll probably take some sort of exogenous shock, which could get hikes really into the equation. But equally, our point for now is getting from there to 2% looks quite challenging, which is why we don't see a rationale for continued cuts.
Is there some degree which we should look at these data points as a jumping off point? That is to say that we are going to see inflation's true path coming forward once we pass the inauguration, once we hear different policy for Donald Trump. Is this only the beginning of something that, again, could be an inflationary path?
It's possible. We'll really have to see. I mean, you talked a lot about policy uncertainty as well in the previous segment, and I think there is a lot of uncertainty. So we'll see how things play out. We have made it clear that we think the risks are skewed towards more inflationary policies, but nobody really knows what's actually going to happen, right? So we'll have to see how things play out. I think it is worth noting that last time around, there were a lot of expectations that tariffs would be super inflationary, but the dollar ended up absorbing a lot of the shock. There were a lot of exclusions and so on. So the tariffs didn't actually end up being that inflationary.
Well, then going to David Kelly's point, talking about this policy uncertainty and this wait and see, does this basically mean paralysis as you wait for this unpredictability, because the incoming administration wants a lot of optionality when it comes to how are they going to enact some of these things like immigration policy and tariffs?
Right, sorry, I lost you for a bit. I'm not sure what the question was.
Well, are we going to have basically just economic paralysis, this wait and see, and can that in itself hurt the economy?
Right, so we're pretty optimistic on the trajectory of the economy, to be honest. Economic paralysis isn't really our outlook. We think we're going in with significant momentum. We are above consensus on growth for this year, primarily because of structural growth, right? So we see productivity as a big driver of growth over the last couple of years. We think that can continue going forward. So we think we can grow at 2.3% this year, with tariffs maybe putting some downside on growth, but then equally, if we do get some fiscal stimulus, that could buoy the growth environment.
Aditya, appreciate your time, sir, as always. Aditya Bhavedev of Bank of America Global Research, off the back of this inflation print. Aditya and the team changed their call in the last week. They don't expect any interest rate cuts in 2025. This inflation print just bakes a little bit more chance that we do get an interest rate cut through 2025. We've said repeatedly through this year, though, so far, and we're only about 2 weeks into it. This was a three-part story in January. Payrolls, really, really good. Great news. Okay. CPI, downside surprise. That's 2 out of the 3. The third drops on Monday, January 20th. The biggest data point of the month is inauguration. And what's going to be interesting to see over the next few days is whether this move in equities, higher, bond yields lower, dollar weaker, sticks into next week, when we're all expecting a lot of executive orders.
So there's going to be a flurry of executive orders the first 48 hours. Has it been explained to me? One thing I think we still are waiting on, though, we're going to have executive orders on energy, on immigration. What does Donald Trump do when it comes to tariffs? There are 2 competing factions with his incoming administration. Not even all of these plans have been put in front of him, so he has yet to make a decision. Is it going to be what he promised on the campaign trail? Blanket tariff, 60% on China, 10% tariff wall around the United States? Or is it going to be an incremental approach that Scott Bessent on this program has talked about, 2-5% every few months, and then your adversary lets you know when it's starting to bite and they're ready to make a deal.
And who's to say we're going to get that anytime soon, any clarity? Again, I go back to this idea. I keep seeing commentary over and over that this bond market is waiting for clarity and that we will get it once we get all those executive orders coming through. Unpredictability is a feature, not a bug of Trump's policy outlook. If you are waiting for some kind of clarity, that might be a problem. And again, it's this idea that longer-term yields are going to continue to be higher because we're not going to get that clarity at least anytime soon.
We're getting whipsawed, data point to data point, and we get another data point or two next week from the incoming president, Donald Trump. If you're just joining us, moments ago, a little bit early this morning, about 17, 18 minutes ago, inflation came in a little bit lower than expected at 0.2% on core inflation, month over month. Stripping out food and energy, it comes in at 0.2. The estimate was 0.3. Unlocks much lower bond yields across the curve. On a 2-year, we're down by 8 basis points. On a 10-year, we're down by close to 10. Off the back of that move, push it through foreign exchange. The dollar is weaker. Euro dollar back to about 103. And in equities, on the S&P 500 up by 1.6%. The Russell is flying. And as we say all the time, this is the first move. Doesn't mean it's the right move. It's the obvious move. Let's see if this move sticks into the closing bell later on this afternoon. Let's give you an update on stories elsewhere this morning. Some breaking news as well from Apollo moments ago with the latest in your Bloomberg brief. Here's Yahara Hackes. Hey, Yahara.
Hi, John. Exactly. Apollo announcing management changes this morning. According to a company statement, CEO Mark Rowan agreed to a 5-year contract extension. Meanwhile, Jim Zelter, who was just on this program last week, was elevated to president, which is a newly created role. John Zito, who was head of credit, will take Zelter's place as co-president of the asset management business. Meanwhile, shares of the biggest U.S. banks are rising in the pre-market after reporting better than expected fourth quarter results. At J.P. Morgan, traders posting their biggest fourth quarter haul ever, while Wells Fargo boosted its 2025 net interest income forecast. At Goldman Sachs, earnings per share handily beating estimates, and Citi announcing a $20 billion buyback. And Bloomberg News has learned that U.S. health officials plan to ban the artificial food coloring red dye number 3. The announcement could come as early as today, according to people familiar. The dye has been linked to cancer and is in products from candy to cold medicine. That's your Bloomberg brief. John?
Yahara, thank you. Check out Apollo. That stock up by 3%. One of the best management teams on the street in asset management. Rowan sticking around for 5 years, a new 5-year contract. Zelter, Danny, getting a promotion.
And this also comes after there was some speculation as to whether Rowan would be going into the Trump administration. This is the kind of succession planning that gets the market excited. Maybe not ones like BlackRock or JP Morgan with...
Yeah, I wasn't going to name names, but you went there.
I'll do it. Why not?
But at least this one's
morning.
cleaner. I will say that. Up next on the program, setting you up for the day ahead, looking ahead to an opening bell with equities up right now quite nicely. From New York, this is Bloomberg.
Is the Vivian Tom clientele? Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world. Why do you position your products for this group of women? When I started, designing, I always want to do something that is empower women. When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example. My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s. So it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
If you're an equity bull and you woke up look from JP Morgan, record earnings from the traders over at Goldman Sachs in the fourth quarter on the equity side of the business, just solid numbers from Wall Street. You got that. And then you asked for a little bit more. You wanted a downside surprise on CPI, and 24 minutes ago you got that too. Equities up by 1.5% on the S&P, on the Russell up by 2.9%. With some movers, it's Manus Cranny. Hey, Manus.
Jonathan, that's a fairly great backdrop for risk. Jane Fraser had the high bar to deliver over at Citi. The stock is up just under 6%. Yes, FICC did really well, up 37% for them at Citi, but it's the buyback which is there. And in terms of the fly in the ointment, return on equity capital, that's a waypoint, she says, not a destination. Wells Fargo are cutting costs. They took a $647 million severance charge. Charlie Scharf is saying the cost cuts are in the early stage. They've gone from 272,000 down to 217,000. I'll leave you with a look at BlackRock. They have sucked in, the vacuum cleaner is on, they've sucked in assets under management, 11.55 trillion, up 15% on the year. And that was lighter than the estimates. Jonathan.
Stock is up by 5% on BlackRock. Manus Cranny, appreciate it. Thank you, sir. What a morning. More still to come. As we work through the trading week, the calendar looks a little bit like this. You'll get some Fed speak going into the quiet period of the weekend. Fed speak from Barkin, Kashkari, Williams and Goolsby tomorrow. More earnings from Bank of America and Morgan Stanley, plus retail sales and another round of jobless claims, plus President-elect Donald Trump's Treasury Secretary nominee Scott Bessent on Capitol Hill for his hearing. Look out for that. On Friday, some more data, housing starts and building permits. Looking ahead to next week, inauguration on Monday and the World Economic Forum kicking off as well. And Anne-Marie, understand that the incoming President-elect Donald Trump is going to be calling in to the World Economic Forum from Washington, D.C.
Well, it'll be very challenging for him to get there, given the fact that he does have this America First agenda, and he's just being sworn in. So he's going to do all these executive orders and then probably lecture the global elite you'll be hanging out with.
And then I'll be asking him questions. What are you going to do? How are you going to respond? How do you feel about this? How confident are you about the year ahead? And the answer to that question will depend on whether you're based in America or elsewhere.
And you might just say, actually, we don't have enough information yet. It's still a lot of very unpredictable, and there's a lot of optionality.
Probably punting it is a good idea. Up next, tomorrow morning, we'll catch up with Cameron Dawson of New Edge Wealth, David Leibovitz of JP Morgan, Francis Donald of RBC, and the former Fed Vice Chair, Richard Clouder. From New York, thank you for choosing Bloomberg TV.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
One of the institutions you've been very philanthropic with is your alma mater, Harvard. But recently, you've been very public about your criticism of the way Harvard handled the events of October 7th and their aftermath. Could you talk about that now?
The first reaction of a group of 34 Harvard student clubs on the morning after October 7th was to put out a statement saying that Israel was 100% responsible for the acts of Hamas. And And my view on that was, that's ridiculous. You can come out and say, look, I'm very unhappy about Israel's treatment of Palestinians in the West Bank, or you can say, we can talk about the Gaza Strip, but you can't support terrorists, and particularly terrorists that rape and pillage and murder and burn and take hostages. Well, I got actually a text from a CEO in my industry. He's like, Bill, you know the people at Harvard. I'd like to know who the students are behind these clubs, so I make sure I don't inadvertently hire them. And so I tweeted out that sort of made that point, and caused a bit of a firestorm, and I got a lot of pushback. Why are you picking on students? And I said, look, you can't hide behind a corporate entity if you're going to support terrorism.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race. And Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank,
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We are off to the races. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Shonali Bassett. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming off a slowdown in consumer prices bolsters bets or brings bets back that the Fed will be able to cut rates. Earnings season kicks off with JP Morgan, Goldman Sachs, and Wells Fargo all reporting robust results, to say the least. And BlackRock pulls in a record $641 billion in client cash last year, with Larry Fink saying that is just the beginning. Let's take a look at where markets are trading, with futures up bigly, looking at 1.5% gains on S&P futures. NASDAQ futures up 1.8%. The reason is right there. The 10-year yield coming down after CPI missed estimates. It was cooler than had been anticipated, and that means that investors can start betting on Fed rate cuts again, to the extent that they were before. Shonali, it was a number that I think the entire newsroom and all of Wall Street was watching.
My anxiety levels were through the roof this morning when we were at 476. Now we're at 467. We can all sleep easy. Although you might not want to be asleep, because some stocks are just ripping along with the market here, and you can see it in the banks. The trade just building all morning. JP Morgan blew past estimates after its trading desk notched a record fourth quarter. Election swings had something to do with that. Citi is buying back $20 billion in stock. Wells Fargo sees net interest income rising around 2% for the year. Goldman also just soaring, traders beating expectations, and the stocks, as you can see, all up bigly as well. I'll look at some of the banks reporting tomorrow as well. Morgan Stanley, Bank of America also already showing some love on the screen here. Big trading desks here. Investment banking rebound. We'll watch for net interest income over at Bank of America. Lazard. Also with that investment banking rebound at the other banks, you're seeing Lazard stock rise in synchrony, up about 8.6% pre-market. BlackRock, Mr. Larry Fink, saying, of course, that, yes, this is just the beginning. Record client cash inflows for 2024, 11.6 trillion in assets under management. We're just shy of expectations. So you could see, Matt, expectations are still high after a banner year.
Yeah, and I mean, I think the inflation report, the effect of that can't be understated. We saw a super core that came in at the lowest level in I would say, almost a year here since July in terms of the month-over-month supercore. This means that investors who are psyched about tax cuts and deregulation can also be psyched about Fed rate cuts. And that's really what this market needed, because for the past couple of weeks, we were freaked out that inflation was going the wrong way.
Yeah, I was really struck by Larry Fink's comment this morning that you could see the 10-year go to 5.5%. We were looking at that together right before that inflation data came out.
That's not so shocking, right?
Not so shocking when we were flirting with 4.8%, but now, as you say, we're comfortably below 4.7%. All is well in the world for now.
Let's find out how well all is right now. We'll bring in Michael McKee. He is our international economics and policy correspondent. Mike, what was your read on the cooler inflation numbers that we got?
Well, it was a reasonably good number. It's not an excellent number. It doesn't bring inflation down any really closer to where the Fed wants it to be in terms of the CPI. The real question is how about the PCE at the end of the month and CPI and PPI in now. We'll get some numbers on that from the economists in a little while later today. But the thing to look at is the headline number came in bang on expectations, 0.4%, but the core up just 0.2, which pushed core CPI down to 3.2%. That's the lowest since August, and it is a little bit of progress. Gasoline prices went up. You knew that. Natural gas, no surprise. It's been cold. Airfares, a big contributor. Not as much as in PPI yesterday, but they were up 3.9%, and used car prices continued to rise. What went down? Eggs, medical care, health insurance, and apparel. Some of those things feed into the PCE. The thing you want to look at politically, eggs, of course, up only 3.2% compared with 8% the month before. It seems like Joe Biden solved that problem before he left office. The inflation measures that I mentioned, everybody's looking at is PCE, because that's what the Fed's going to make its decision on. And we have to wait and see how all this fits in, the people who crunch the numbers doing that. But what we have seen so far is PPI and CPI in the last couple of months pulling that inflation number, the PCE one, the yellow line there, up. And that's not what you want to see. If that gets closer to 3%, people have talked about, well, then the markets are going to start anticipating a rate increase. So if these numbers help push that down, that would be good news overall for the markets. But what's interesting is, you mentioned we're in good shape now, at least for 24 hours, because what ends up happening is every little thing gets traded on, and the big thing doesn't happen until next Monday. So let's see where we are on Tuesday and Wednesday of next week. But for right now...
Are you talking about the college football playoff?
Exactly. Right now, where we are, you look at Fed funds futures, and we saw them.
I'll watch with
we saw a big move. Everybody was pricing in a September move as the first one. Now we get a July move as the first one. And this just shows that, as you mentioned, the markets are very, very sensitive to every data point at this point.
Data points, events, inauguration, all of the above. First 100 days. Michael McKee, we thank you so much for joining us. We're excited for the next set of data because, of course, everything always changes and then the next one drops. Turning now to the banks, JP Morgan trading blew past estimates, while Wells Fargo sees net interest income rising up to 3% annually in 2025. Bloomberg's Sridhar Natarajan joins us. One thing that struck me about the results is, in addition to Wells Fargo raising the bar on net interest income, they're also recording severance costs. But you look elsewhere, you have Citigroup narrowing the profit target range. You have Goldman saying headcount increased, but operating expenses decreased. It looks like the banks, speaking of inflation, are ready to tell investors, let us spend some money here so we can keep growing faster.
And I think when they talk about the catalyst of what lies ahead, both in terms of improving CEO confidence and what that means for deal-making activity, what their biggest clients in terms of the biggest buyout firms do, and the fact that they are increasing activity, and the very obvious likelihood that some of these onerous regulatory proposals get rolled back or not get implemented, that is going to measure good news for banks going ahead.
So Jamie Dimon mentioned the two big risks. Inflation is one that we, I guess, have dealt with pretty thoroughly now. And geopolitical risk, war is another, right? Hopefully part of that gets solved soon as well. Is this going to be a banner year for these banks?
It's setting out that way. If you look at the run-up in all their stock prices heading into year-end, that is what it certainly augurs for the banks ahead, because the stocks will not be up 30, 40, 50% if you're not expecting a really good 2025. But banks are out there to tell you, not just are they going to have a good year, it's going to be better than what you're expecting, because we're still not close to seeing some of those long-term averages when it comes to all of that deal-making activity. And already in the first week of this year, we have seen enough signs that people are ready to go out and transact.
Speaking of people going out and transacting, it means that you got to make your people happy. I'm looking at the headline from this morning, Apollo promoting Jim Zelter, John Zito getting a promotion as well. These are people who have led their credit businesses for a very long time. What does this mean? You also had changes at JP Morgan, people being elevated. You have somebody very senior leaving BlackRock. What is happening under the surface right now?
It's very interesting. We've had a very busy 2 days when it comes to some of the biggest firms that we care about. JP Morgan, obviously, we saw the changes with the new CEO, and we were wondering what that means for succession. Didn't get much clarity. Yesterday, Mark Wiedman left BlackRock. That is important because he was seen as one of the likely successors to Larry Fink. So there we're still trying to figure out is, does Larry Fink have someone within the BlackRock stable that he could tap, that his board could tap and elevate to be his successor? Or will he have to look outside the firm? And now at Apollo, this one's interesting because just a few weeks back, Mark Rowan was in the news about a potential role in the Trump administration. That obviously set out a lot of conversations and questions from investors and analysts. Now, with them indicating that Mark Rowan will extend his contract for 5 years, that means he's going to be in that spot. The next generation is elevated. They've created a new role for Jim Zelter as the president of the entire firm and elevated John Zito, who's had a super successful run running and shepherding the credit business at Apollo in recent years. And that, of course, is a big money spinner for Apollo.
It's very possible John Zito is your next CEO of Apollo after several years, if Mark keeps leading for a lot longer.
Well, he's a pretty cool guy, so we're excited about that. Sri, thanks very much, Sridhar Natarajan, talking to us about the banks. We are now joined by BMO Private Wealth Chief Market Strategist Carol Schleif. Carol, what do you make, first off, of the slightly cooler inflation numbers that we got today? I know 1 month does not make a trend, but the markets are reacting very positively.
Clearly, the markets are relieved by the numbers, and I have to admit, I agree with you too. I'm relieved too. Came in with very high anxiety this morning looking at the number, but it's really important for investors to put into context the fact that all of these numbers that we're hanging all of this anxiety on are backward-looking numbers. And there's a lot more important stuff coming out. You've talked about the bank earnings. We get the beige book. We really have to look at the underlying economic fundamentals, and they're chugging along pretty nicely. And the fact that they're in balance is pretty nice. You know, we've still got inflation running above where the Fed says its target is. But when you look back over decades, the long-term average of inflation is closer to 3.5%, 3.8%. And so figuring out, that's what both stock and bond markets are trying to figure out, is what does that new normal look like? Does it look like the last 20 years, or does it look like the 40 or 50 years before that? And our suspicion is it looks like before that we're not going back to 0% kinds of normal rates, but rather those low single digits. Is it 2% or 3.5%? It's someplace in there, and we're moving into that range.
Carol, you know, it's interesting. I think I drive Matt crazy because even when all the data is great, I look for the bad things just to keep an eye on risk. Does it bother you that headline inflation is not as promising as what you saw in core?
Yeah, there is that piece of it, and it's also important to remember that a lot of what drives the core, when you think about insurance costs, airline flights, used car costs, those things are going to stay sticky for some period of time. Look at the housing market too, or look at even the pressure that's been put there. We had the Fed cut 100 basis points, and yet we've added 100 basis points to the 10-year during that time frame, and that's what mortgage rates are tied to. So there's still some stickiness in the economy. But that said, animal spirits are at least purring in the background, if not getting ready to roar. You're seeing the banks structure themselves, getting ready to participate, hopefully in lighter regulatory touch, more ability to do M&A and IPO, and that's really solid for underneath. So whether or not we hit the Fed's target of 2%, we think that focusing on the economic fundamentals and the way this thing plays out are what investors should be focused on.
There's been a couple of reports over the past few weeks, Carol, that Trump's tariffs are going to be more gradual or lighter than, the bluster on the campaign trail. I don't know if that's just because media is obsessed with Trump's tariffs or because it really matters to inflation figures. How do you see it?
Well, I think a piece of it is it's important to remember it's not just tariffs. There's a whole bunch of policies. The interesting thing is having markets closed on Monday, and I suspect there's going to be a lot of announcements out on Monday. So it's really a buckle up and get ready for what comes in the next week or so. But tariffs it depends on how they're deployed. They're not just a market obsession. Trump has clearly voiced preference for using tariffs in a variety of factors. There's the across-the-board tariffs. There's also tariffs to elicit a certain response from various trading partners. And so there's a variety. Figuring out how they're implemented and watching will be important. But I also think it's important, too, to realize that tariffs in a Trump 2.0 presidency aren't necessarily similar to Trump 1.0, because coming through the inflation scare that we have, if tariffs are applied more broadly towards consumer goods, it's going to be tough for those importers to pass those along because consumers are so resistant to inflation. And so there'll be some absorption, I think, in margins of the companies, because tariffs realistically are a tax on whoever's bringing the goods into the United States. And that entity has to figure out how they're going to deploy them, whether it's through margin enhancement internally or passing them along.
Carol, one thing about bank earnings is that it's kind of like the unofficial start to earnings season. There's some that come before, but this really kicks off the wave. Fair to say they were pretty blockbuster. And if you think about what we might see ahead of us in terms of earnings, do you think that the rest of corporate America will follow suit?
We do think you'll see a broadening in the earnings health. You've had technology earnings that have been gangbusters, especially in a narrow set for a very long period of time. But you're starting to get base effects there where it's hard to grow at those rapid double digits on top of the rapid double digits you've been growing at. But you're seeing more and more optimism and more opportunity for those mid and small cap stocks and the other 493 S&P 500 companies. You're seeing it in market reaction today. The bank stock earnings and the more muted CPI are really driving the Russell 2000 and the S&P 600. Those smaller companies are participating. And we think you'll see solid upper single digits, lower double digits in aggregate of earnings across those companies.
All right, Carol, great talking to you this morning. Thanks so much for joining us on CPI Day. BMO Private Wealth Chief Market Strategist Carol Schleif talking to us about these markets and the reaction. We have futures rising. Coming up, Baird Senior Analyst David George will give us his reaction to the bang-up numbers from JP Morgan. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
You're spoken, sorry.
My voice and my conversation, my poetry, you know.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Checking in on shares of JP Morgan and Wells Fargo, where there has been a trade building all morning long. You're now JP Morgan up about another 1.3%. This, Matt, is a bank already trading well above 2 times book. Wells Fargo almost 5% higher, touching that mark. Got a lot of other banks also that are rising in synchrony. Now, Baird senior research analyst David George has an underperform rating on JP Morgan, a neutral rating for Wells Fargo. He joins us now to discuss. It's interesting to see Wells Fargo raise the bar on net interest income. JP Morgan, when you read through their presentation, they told investors here that they're going to be spending more on bankers, on advisors. They're looking for growth. But how much more upside is there after such a large rally, particularly since the election?
Yeah, good morning, Shanali. It's good to be with you this morning. So yeah, from our perspective, the numbers from both JP Morgan and Wells were very good. I think expectations were anchored a little bit down given the pullback in the banks and the market over the last couple of weeks. So the stocks, I think, have been de-risked a little bit going in. So between that and a benign CPI this morning, I think it's reasonable to expect a lift in the banks today. From our perspective, Wells probably has a little bit more upside because the stock is cheaper. JP Morgan is over 2.5 times tangible book. Wells is closer to 1.5 times. And Wells is actually, as you mentioned, Shanali, guiding to more upside in net interest income relative to JPM. And to your point, JPM, and this is not surprising, JPM, one of the reasons why they have done so well for so long is they have consistently invested in the franchise through adding bankers, adding verticals, adding technology, investing in IT to give them the ability to grow. They're also, since they cannot really do any meaningful deals, they're continuing to invest, and that expense growth should, over time, result in better revenue growth as well.
You know, one thing that a lot of investors think on first blush is that you look at that rise in net interest income expectations from JP Morgan and Wells Fargo, and that there could be a read-through across the banking system or something like that. Do you think that the regional banks will get as lucky when it comes to more lending profits here just because rates have not fallen as much as expected?
Yeah, so I think both JP Morgan and Wells Fargo is what we would characterize as higher for longer stocks. So a Federal Reserve that is not poised to cut relative to expectations maybe a month or two ago. Wells, JPM, and B of A, I think, are more beneficiaries relative to the regionals. However, today's reports clearly, we think at least, are good news for regional banks. Keep in mind, regional banks are 70 to 75% driven by net interest income relative to the money centers, which are much closer to 50 to 55%. So this should bode well. In addition to today's CPI number, should bode very well for regionals. We would actually expect the regionals to outperform the likes of JP Morgan as trading starts here in a few minutes this morning.
Well, and you have a big coverage universe, David. I'm just looking at at least 18 companies that you cover. Those regionals are the ones you like the best: Citizens, M&T, PNC, Comerica. Why is it that you like them so much better? You don't have any outperforms on the big money center banks. So why is it that you like the regionals so much better?
Yeah, it's a couple things. So so first of all, it's an expectations gap differential is what I would characterize it as, Matt. Post-election, we saw a big move in the money center banks on the expectation of higher fees, higher capital markets activities, et cetera. And that is a very reasonable expectation. But the street already took up numbers for capital markets and expectations from a valuation perspective for 2025. So whereas on the net interest income side, we think there's actually significant upside coming for the regionals as banks continue to benefit from the repricing of assets, which is really a timing issue with the Fed tightened so aggressively. The asset side of bank balance sheets is now finally having time to catch up, and we should see fairly good net interest income growth out of the regionals as they benefit from net interest margin expansion. On the loan growth side, it's still relatively soft, so that's a potential call option, we think, for better net interest income in 2025 as well.
All right, David, great to get some time with you. Hope we can get you back. Baird's David George there talking to us about the banks, big and, not small, but big and medium. Later today, we're going to speak with the CFO of Wells Fargo. You don't want to miss that interview at 3 p.m. Eastern Time. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Quick check on futures. After that cooler inflation number came out this morning, we saw rates come back down and futures shoot up. S&P futures up 1.4%.
It's almost at 6,000 once again. Can you believe it, Matt?
Yeah, absolutely. And it's really the banks pushing us up, or financials adjacent. Lazard is up big today. We're seeing Wells Fargo up big, BlackRock up big, Bank of New York. We'll be back with more on the big banks, beats, and the equity gains we're looking to see at the open.
it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Bullishness is back. Moments away from the start of the cash trade, this is Bloomberg Open Interest. I'm Matt Miller. We are seeing futures gain more than 1% on the major averages. The Russell right now, futures there up 2.5%, as a lot of these companies don't make any profits and they really need to refinance, so rates have to come down for them to do well. You can hear and see the opening bells. Pitney Bowes at the New York Stock Exchange. I would have thought it's a much bigger company. It's actually only $1.3 billion market cap, but it has more than doubled over the past 5 years. You have health in tech on the NASDAQ. They just went public a couple of weeks ago at $4, and they're trading at $6, so that's a pretty good move. A check on the major averages in terms of what we're seeing in the live trade this morning. Going to look a lot like futures. Very good. S&P 500 right now. Is this the cash trade? Up 1.4% at 59.25. So to Shanali's point, just 75 points away from 6,000 now. Again, NASDAQ up more than 21,000, a gain of 1.5%, and the Russell 2000 up more than 2.5% at 2276. In terms of the stocks to watch, these are all of Shanali's favorites. JP Morgan knocked the cover off the ball with trading. Wells Fargo, Goldman Sachs, also big beats. Among the banks with higher earnings and revenue, the sector really topping Wall Street expectations. Trading desks capitalizing on election volatility last quarter. Net interest income growth looks solid for 2025. Remember, wasn't it just a couple of months ago when JP Morgan warned on net interest income? It's only going to be $87 billion. Now they're saying 94.
That's the game. You set the bar low, and then I think it's you knock the ball out of the park is the saying.
The cover off the ball.
Whatever. Anyways, also rising. Goldman more than 4% as the market opens. BlackRock another 5%. Interesting here. Goldman profit doubled in the fourth quarter. Traders just knocked it out of the park as well. BlackRock making the biggest gain since 2022. Rapid growth under private assets. Assets under management ballooned to $11.6 trillion. More on results later this hour. They added as much money as a small asset manager would have. Let's raise the board. Look at regional banks here and BNY Mellon, because shares rising after profit and net interest income top expectations. Fourth quarter profit exceeded analyst expectations thanks to higher interest rates. Unchanged at the open, it looks like. This has been a darling of the financials in recent months, Matt.
Yeah, absolutely. And the futures were up big. There you can see it now, up 4%. Sometimes it takes, 30 seconds, a minute, a little more for a stock to open up, and I think that was the case with BNY Mellon. A big bump along with the rest of the financials that we're watching. Joining us here at the desk is Alpine Saxon Woods Chief Market Strategist Sarah Hunt. Sarah, I got to ask you first about the CPI numbers coming in a little bit cooler, and that really changed the tone for this market.
It absolutely did, and this is where you're seeing that data by data point. Each one is going to make these big swings, because when it looked like inflation was getting a little hotter and the Fed was getting a little more hawkish, all of a sudden you had a really tough December, and you had a tough start to the year. And so I think that if we can see that progress or stay where it is as opposed to get worse, I think that's going to be good news for markets. And you can see that here, plus good earnings.
It's interesting. Good earnings. BlackRock shares are actually rising the most since November of 2022. KBW is the biggest in a month. Financials were part of that broadening trade, weren't there? Were you as optimistic as other parts of the market as you were about financials here? Do you think there's still underpriced opportunities to pick up into earnings season?
I think that the financials were one of those places where they got some enthusiasm on the idea that you'd get regulation, some relief there, but I think that the numbers had to come through, and I think that what we're seeing this morning is very good for equity markets, because we're looking for some growth. Everyone's looking for earnings growth into next year. You have to figure out what sectors it's coming from. People have been relying heavily on technology. I think there are some areas, but the market as overall is not enormously inexpensive at the moment. So you do definitely need to see those earnings come through, and I think that today was good for that.
One of the other things that I didn't count on, and I think a lot of other market participants didn't really see coming, was rising energy prices. Brent crude is now back up over $80 a barrel, WTI rapidly approaching. As we enter, a new period of drill, baby, drill, why, and what does it mean?
So I think that there are some things that are going on in the energy markets that are somewhat specific to a change in someone trying to enforce some of those sanctions that were very not enforced for a long time at the end of this administration. That's part of it. It's playing into some of the other issues that are going on in terms of transportation. But to be fair, there's quite a bit of oil production, and demand is better than expected, but it's not so strong that this is a driver. There's some idiosyncratic things that are going on in the oil markets.
Yeah.
I'm not sure that we can expect oil to stay this high, and I think that there is more of a regulation relief expectation more than necessarily a bump in production. That just means that there can be more steady things and less bottlenecks.
I saw a headline this morning that Europe is planning to phase out Russia's natural gas, and I was thinking, how insane, that 2 years into this, Europe is still funding Moscow's war on Ukraine. It's just nuts.
I think it just shows you that no matter what you would like to do, the reality on the ground is you have to keep people warm, you have to keep the lights on. All of these things are connected very, very tightly. And unfortunately for Europe, they were quite tightly connected to Russia for a number of years. So turning that tap off and trying to find a substitute has been difficult. It's one of the reasons that we like natural gas. It's one of the reasons we like LNG plays here, because I think that there's going to be a continuous stream. And I also think that there's been a big shift where people are realizing that you're going to have an and on hydrocarbons and not an or. And that and is going to last, that tail's going to last a lot longer. I mean, we've been saying that, but those stocks haven't really been reflecting that. I think you're starting to see that much more this time.
Something that's been interesting me in the trade this year, speaking of other sectors outside of technology, the energy sector has also been impacted by the technology sector. You see companies like Constellation, the promise of nuclear really drives some stocks meaningfully higher. And I wonder if you see a bubble forming in some of these AI adjacent stocks.
I wouldn't say that for the energy sector as a whole, because I certainly was reading some stuff. We're looking at a couple of different companies, but there's a lot more that they can do on cost now because of AI on the service sector to the oil business. On the utility side, it's hard to say what that is, because these are assets that are difficult to replicate. So are all of a sudden we pricing it now on assets as opposed to earnings? That makes a difference. And I think that there is some concern about how fast some of those stocks have gone up relative to their earnings power, but it starts to be a fight for assets.
Jamie Dimon today said the two risks are inflation for 2025, are inflation and, a war, essentially, geopolitical risks. You say defense stocks are a sector that doesn't look expensive. Why haven't they been bought up?
Because the decisions or the discussions on government efficiency and the concerns about whether or not we're going to stop spending as much on defense because we've got other budgetary issues, I think has coalesced into the defense group just not acting that well. But I don't disagree that the global political situation is not calm at the moment. So I don't think that I think the defense stocks got rotated out of, and they look interesting to us here. And there's a lot of, we saw the hearings yesterday, right? So there's a lot of question about who's going to lead what and what that's going to do to current contracts and everything else. So I think that there's a lot of flux. And when there's flux, those stocks tend to be unloved for a variety of reasons. But you've got some decent yields there, and you've got some decent balance sheets there. So I think that there's some room there.
Speaking of decent yields, you're looking at a 10 basis point or more drop across the curve on the heels of that CPI data. Of course, that gives fuel to the equity markets. But I don't believe anything I see anymore. These markets have been so volatile, particularly the bond markets. How much more concern do you still have, even with a confident CPI print, about the direction of yield?
No, even with that drop, we're still at 466 on the 10-year.
Well, so this is the issue, because all of a sudden we started to creep back up to 5%, and people really started to get worried. And there's a psychological thing about 5% that's probably more than an actual thing about 5%, but it's whether or not, are we still in an easing cycle? Are we in a pausing cycle? Are we going to have to go back to a hiking cycle? I don't think we have to go back to a hiking. We don't think we have to go back to a hiking cycle, but you might pause for a lot longer than people thought, and that's tough, which is why, we're very much on capital return and balance sheets. So what do your balance sheets look like? What does your cash flow look like? That is something that is not going to be solved by an interest rate cycle coming down. You have to be good at this under any interest rate regime, and I think that's that's what got markets very rattled through December and the beginning of January, and some of these prints are giving a little bit of relief, but the relief is just kind of going back to where we were before we started to get really worried.
Sarah, we thank you so much for joining us here on set. Of course, huge start to earnings season. Looking forward to seeing how this one goes. That is Sarah Hunt of Alpine Saxon Wood. She's the chief market strategist there. And now to high interest, because there are a lot of headlines around the world, Matt.
Yeah, the SEC is suing Elon Musk over his purchase of Twitter. The agency accuses the billionaire owner of not declaring his stock purchases in a timely fashion, depriving Twitter owners at the time of the real value of their shares. Musk's attorney didn't hold back in response, accusing the SEC of harassment and calling the charge a sham. And don't worry, it's only a week until those guys are out. Israel and Hamas are accusing one another of delaying a Gaza ceasefire that would involve exchanging hostages for prisoners and sending aid to the beleaguered Palestinian territory. Officials say an agreement for a 6-week pause in the fighting is still likely soon. However, past failures to get a deal finalized is leaving room for caution. And in the wake of the fires ravaging Los Angeles, real estate vultures are circling the middle-class community of Altadena and other burnt-out parts of the region. Those vulture investors are offering unsolicited and lowball offers for properties that were impacted by the wildfires. Yesterday, Gavin Newsom, the governor, issued an executive order banning these practices for 3 months.
And coming up, the U.S. plans to unveil new regulations to prevent chips from being sold to China. We're going to take a look at the final push by the Biden administration next. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets
with the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Let's get top calls right now. Some of the analyst action that we are watching this morning. First up, KB Home is no longer a sell at Seaport Global Securities. The home builder getting upgraded to neutral. It reported earnings and sales that topped estimates in the fourth quarter earlier this week. KB Home is also based in Los Angeles. The CEO speaking on the analyst call said it was too soon to calculate the impact of the fires on the company's business. Next up, Stifel says XPO is no longer a buy, downgrading the trucking and logistics company to a hold. The analyst says the downgrade reflects the stock's near peak valuation. And finally, Bernstein is upgrading EQT to a buy. The firm says the energy exploration and production company will benefit from significant power demand growth. Bernstein also says the new U.S. gas landscape will see significant but highly uncertain growth until 2030. Shanali?
And Matt, as we've mentioned, the Biden administration turning the heat up on China in its last week. It's planning new regulations to prevent advanced chips from being sold to China. The rules aim for more chip makers to more carefully scrutinize customers and increase due diligence on who they're selling to. Here with the latest, Bloomberg's Caroline Hyde. How do you take stock in these last set of moves, and what will be made of them in the next administration?
Key question, what happens in the next administration? Under this administration, they are moving thick and fast to be able to basically stop what happened in the past. Huawei, which is on the entities list, managed to get hold of TSMC chips, and we're using them in the process for some of their most sophisticated chips they were making in-house. Now we start to see that wants to be curtailed. TSMC, for example, is going to be limited. It cannot sell anything more superior than sort of 14 to 16 nanometer chips. But also there's an interesting nuance. 30 billion transistors. Basically, these are the switches that are being pushed more and more onto these chips to make them more and more powerful. The more transistors, the more powerful they become. Now, 30 billion and above is basically okay. Now, and below, in terms of the amount of transistors. That actually, according to Bloomberg Intelligence, isn't that bad. They're saying, look, maybe we'll see TSMC be able to hold on to about half of its sales of chips into China at the moment, because they're still going to be able to sell the less powerful chips that go into smartphones and PCs and the like. But it's AI accelerators. It's the development of generative AI that is the key concern for the U.S. administration here.
I'm sure we all recall the great New York Times piece on how even U.S. chip makers don't follow the rules and sneak chips into China.
Or don't look hard enough.
Sorry?
Or don't look hard enough.
Right. I mean, if we can't even regulate our own companies, is there any hope that we're going to be able to regulate Taiwanese companies?
Well, it seems as though thus far there've been a lot of focus on the Japanese, the Europeans, and basically all allies who sell sophisticated chip-making equipment, whether that be ASML with their chip-making equipment, whether it's the Japanese as well, or whether it's Taiwanese with Samsung and with TSMC. There is a hope that you can clamp this down. There is by trying to maybe give the odd inch here by the fact that you can get on a list that says, we trust this particular partner. Maybe you allow TSMC to say, okay, this isn't as bad as it could have been, so I will oblige to the US administration. But as you say, look, NVIDIA, a homegrown chip maker, yes, of course, Jensen Huang himself is of Taiwanese descent, but he's currently fighting against the latest administration moves on his company because it's making it so complex as to where he can sell, what the level of...
Isn't he currently in China?
He is, yeah. Because it's a huge market for him, so they've got to be able to have this nuance. How much can they give to ensure they don't totally choke off future growth, but also limit the sophistication with which China can start to use generative AI products? Look, we're forcing China to make their own. This is what the outcome is, but it's going to take years for them to be able to compete against chip-making equipment like ASML and indeed chips made by TSMC.
And in the meantime, they do respond. They say that the rules are a flagrant violation here, and this all adds to the rhetoric.
Who says that? China, you mean?
Yes,
Of course
exactly.
they say that.
Well, but you add that on top of a lot of the latest news this week alone. In terms, you think about TikTok, right? Yes, it's a different situation, of course, but the rhetoric is getting more intense.
Yes, and the tit for tat continues. Remember, when we're looking at EVs, well, China has that whole battery market sewn up, and they're going to be starting to limit the amount that we can access their own EV batteries. Remember, that's crucial for the likes of Tesla with CATL.
There's no tit, there's only tat, right? Because none of our social media apps are used in China, and we're so addicted to their social media apps that our president, incoming, is fighting for the ability of a Chinese company to run it. You know, they don't use any of our battery technology. Our major car makers are using their battle technology in Detroit.
This is just another reminder that the next time we have you on, we need to talk about Meta.
Yeah.
is the final word on that, I think, Matt.
Yeah, you're not using Instagram in China.
Globalization worked when it worked, and countries were good at the best things that they were good at making, but now it unravels.
All right, Caroline, it is so much fun having you on.
Always,
Caroline Hyde is going to go off and get ready for her show. She anchors Bloomberg Technology that kicks off at 11 a.m. We are going to go back to the financials. We're going to talk about BlackRock. It saw record inflows of client cash in 2024 as it sold, I think, 400 billion worth of ETFs, and it has a fast-growing private market arm becoming more and more lucrative, that business. It's next in our Wall Street Beat. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power. Live around the world only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is Bloomberg Open Interest. Get a quick check on how stocks are trading just about 22 minutes into the session. Right now, the S&P 500 is up 1 2/3% at 59.41, so getting ever closer back to that 6,000 mark. The NASDAQ currently up about 2%, and the Russell 2000 up 2.3%. So after inflation came in the form of CPI cooler than expected, rates came down, and stocks went up.
They are ripping, and we are closer and closer to that 6,000 level. As you know, I've been waiting to get there all year. But I'm going to look now at BlackRock. The financials are rising, so too is BlackRock, up almost 6%. Assets under management came just shy of estimates at $11.6 trillion. But it received a record $641 billion in client cash in 2024, $390 billion of that going into its ETF business, and $226 billion into equity funds. All of that together is larger than the size of KKR's asset base and many other smaller asset managers. Just incredible. Bloomberg intelligence analyst Neil Sipes has more of the details. One thing that strikes me here about BlackRock is the look forward. You have Larry Fink talking about this being just the beginning, and this year the firm adding more in terms of capabilities in private markets. Controversial question is, are they doing this at a time where fees are compressing in the industry? Because anecdotally, we're hearing that even private markets are looking to give discounts.
Yeah, look, and I think that's something that's pervasive across the space. We know that specifically with BlackRock's legacy platform, the BGI iShares products that they have now. That's been a huge driver of fee compression across the industry, the rise of index funds, ETFs. That's going to have weight across active mutual funds. We've seen that over the past 2 decades. That eventually may trickle into private markets. Again, private markets were starting from a much higher base on those fees. And ultimately, the return opportunities, the uncorrelated potential for those types of products are going to continue to justify those fees longer term in our view.
Well, private markets are going to trickle into ETFs, right? That is the growth that astounds me. $400 billion in ETFs. How much is that set to continue?
Yeah, I think we do expect it to continue. You probably talked to Eric Balchunas on the ETF team here. That's a market that's expected to grow, to 35 trillion.
At the same level, though, right? So this year they could bring in another 400, 500, 600 billion in ETFs alone.
Correct, and that's all really investor demand. And when you sort of look at the go forward over the next 5 years, that's where the growth is expected to be, those passive ETF products. But on the other side,
or active ETFs.
Correct, and that's still a very small piece of the pie there, but that's one that's growing incredibly quick as well. And by the way, those fees are obviously more attractive than a passive type ETF. But on the other side of those ETFs is going to be that private market space. That's where BlackRock is sort of positioning themselves. We talk about that barbell strategy in asset management, passive on one side, alternatives on the other.
Just really quickly, 30 seconds here. Do you think that the future of BlackRock is in the hands of somebody else, really? Because you saw a major executive, Mark Wiedman, leaving the firm. You think about Rob Goldstein, for example, and all the efforts he's made in Aladdin and technology. Is there more growth to be squeezed out of BlackRock as kind of like an everything store, like a bigger technology player?
Yeah, I think that is true. And I think, when we think about BlackRock, it has its hand in all sorts of different categories across the investment management space. So the question for BlackRock has always been, once you're at 11.6 trillion, how do you keep growing? Well, this quarter they really showed us. That's why you see the strong performance today. That scale is not an inhibitor for growth for them, and we'll look for that going forward.
Neil, we thank you so much for breaking this all down for us. Bloomberg's Neil Sipes. And of course, Goldman headlines still coming out right now. The call's still going on, even in a record quarter. I think this is fascinating. They're pushing back on those stress test transparency measures. We talked about that with Erica Najarian. They're talking about expense discipline with vendors. So even if Goldman is paying their employees more, they're telling the people they work with, like, don't expect us to be shelling out all that much this year.
Yeah, the stress test issue, I think, is really interesting for sure. Coming up in the next hour, we have Meb Faber on. He's going to talk markets with us. Diane Swonk on inflation. Eric Hirsch on private markets, and Stephen Diamond on deals at the JPM Healthcare Conference. This is Bloomberg.
race down to the 18 to 35-year-old market. How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, why haven't, we're owning this space.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. A Senate confirmation hearing is underway on Capitol Hill for President-elect Trump's runner-up choice for Attorney General, Pam Bondi. Judiciary Committee Chair Chuck Grassley opened the proceedings.
Ms. Bondi is highly qualified. And of course, as we all know, a change is desperately needed.
Grassley highlighted her work as Florida's first female attorney general, going after pill mills and other initiatives. Bondi's expected to face questions about her loyalty to Donald Trump and his threats to seek revenge on political enemies. The president-elect's first choice to head the Justice Department, Matt Gaetz, withdrew from consideration over questions about sex trafficking and paying for sex. President Biden says an official goodbye tonight. CBS's Willie James Inman from Washington.
In a letter released ahead of his Oval Office address to the nation on Wednesday evening, President Biden outlined what he sees as major accomplishments during his 4 years in office. Mr. Biden noted over 16 million jobs created, increased wages, and declining inflation, as well as bipartisan initiatives he signed into law.
There's more dangerous weather in the forecast for wildfire-weary Southern Californians. Meteorologist Craig Allen.
Strengthening winds, lowering relative humidity, and warm temperatures are going to contribute to this extreme fire behavior, which is going to be redeveloping through the day.
Rescue crews are still pulling survivors and victims from an illegal mine in South Africa. Vicki Barker is at the foreign desk.
Ambulances and mortuary vans encircle the entrance to the abandoned gold mine. My husband is down there. I don't know if he's one of the living or the dead, this woman says. At least 100 dead and hundreds more trapped and awaiting rescue.
The FDA has released a proposal to make cigarettes less addictive by capping nicotine content. Plan's not likely to take effect anytime soon. A similar effort by the president-elect's former FDA Commissioner Scott Gottlieb was sidelined in the first Trump term. Music streaming notches a new record. Industry data provider Luminate says global streams hit 4.8 trillion in 2024. That's up 14% from the year before. And female artists led the way. Taylor Swift was the most streamed. Billie Eilish, number 2. Sabrina Carpenter, the 3rd most streamed. Dow up 716 points. This is CBS. Love. The Securities and Exchange Commission is suing Elon Musk.
The suit claims Elon Musk failed to disclose his ownership of Twitter stock before he bought the site. The suit alleges that allowed him to underpay by at least $150 million. Musk began acquiring Twitter shares in early 2022 and by March of that year owned more than 5%. At that point, the suit says he was required by law to disclose his ownership, but did not do so until later. It's not clear if the new Trump administration will continue to pursue the suit. Musk has linked forces with Trump. Steve Kathan, CBS News.
Dick Van Dyke fans will be relieved to know
gray skies are gonna clear.
The 99-year-old actor safe and sound. His wife says they did not have to evacuate their $8 million home in Malibu because of the wildfires. Van Dyke rescued by neighbors when flames approached their home last month. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
And good morning. Well, the banks are shining, and you know what? They're doing it with other people's money. And this morning, there's jubilation over inflation, and the clock is ticking for TikTok. Good morning. This is Bloomberg Intelligence. Paul Sweeney, Alex Steele are out. John Tucker, Nora Melinda are in. We are your guides for at least the next hour. She's the one in the red, by the way. We're going to kick it off, Nora, with stocks, bonds, and other stuff. Bloomberg's Lisa Mateo does this reset for us right now. Hi, Lisa.
Jubilation for inflation. I love that.
You like that alliteration?
I do. And this Bloomberg Business Flash brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest. Learn more at ibkr.com/RIA. All right, stocks getting some relief after a CPI slowdown. The core consumer price index increased 0.2% after rising 0.3% for 4 straight months. From a year ago, it rose 3.2%. Now, there were also solid results from big banks. We'll get to that in just a bit. I want to get to the stocks. NASDAQ up more than 2%, 412 points. The Dow up more than 1.5%, 672 points. And the S&P 500 up more than 1.5%, 98 points. Yields falling. The 2-year yield 4.27%, down 9 basis points. The yield on the 10-year 4.66%, and that's down 13 basis points. And the Bloomberg Dollar Spot Index down 0.2%. Let's get to those bank earnings. JP Morgan Chase, Wells Fargo, they both posted hefty profit rises for the last quarter. So right now, JP Morgan up about 0.8%, but Wells Fargo up more than 5.5%. Goldman Sachs soared past estimates. Its equity traders delivered their best year on record. We have Goldman Sachs up more than 6%, and Citigroup reported trading revenue for Q4 that beat estimates. Citigroup up more than 6%, and BlackRock up more than 3%. That's after it pulled in an annual record of $641 billion in client cash. And finally, finally, the Bank of New York Mellon reported adjustable EPS for the fourth quarter surpassed estimates. Its shares up more than 5.5%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. John and Nora.
All right, Lisa, thanks very much. John Tucker, along with Nora Melinda today, Bloomberg Intelligence. The consumer inflation data shows us when you strip out all the stuff that we buy, inflation is heading in the right direction.
Right.
Bloomberg macro strategist Vince Signorella joins us now. So maybe the Fed can comfortably cut to boost the economy so that inflation can go back up again? Do I have that right?
No. And I think what you had right was the earlier statement that, yeah, when you strip out everything we need and everything we buy, inflation is benign. The number that everybody's excited about, this one tick change in CPI, was the core number, which strips out pretty much energy and food, which is, as you said, John, pretty much everything we kind of rely on. So all the traders I speak to are pretty much scratching their heads as to where this is going. When you drill into the CPI number, it's really not that pretty. When you look at Empire Manufacturing, the inflation expectations out of Empire not only higher this month, but expectations for 6 months are higher. Everything about this number, there's really nothing good about it. This just looks like a day trader's fun day, and I would expect the long-term hedge fund guys happily fading this rally because I just don't see it lasting. It's not built on a great deal. Anything in the report that was surprising to you, Vincent? Not especially, to be honest. I mean, it really, really wasn't that great a report. The one thing that I think was more interesting than anything was we did see a decline in food prices, which is obviously positive for the U.S. consumer, but we also saw a big gain in energy prices. And when you extrapolate the two and when you look at the two, as a U.S. consumer, you really would probably rather see energy prices coming down. That's probably a bigger part of your budget than food. And so one thing I would tell everyone is look tomorrow. We're getting import and export prices tomorrow. That feeds directly into consumer inflation. Month-on-month basis, there's supposed to be, the forecast is a modest decline, but year on year, it's a big, big jump. So to me, that number is actually more important than CPI. I know the market doesn't think so, but I think the average consumer will. Vincent, how are you thinking about this report in conjunction with what we saw from PPI earlier this week? Well, I think both reports, when you put them together, are basically saying we're stabilizing it with inflation. We're not really making gains, it's just stabilizing, but we're really far away from the 2% target. We're nowhere close. So looking for the Fed to cut rates in July as the market is priced from September, I just think they're just once again getting ahead of themselves. And so to me, it's good news in the sense that that inflation is stabilizing to some extent, but it's showing no real positive signs that it's moving dramatically lower towards the Fed target. And that to me means the Fed's doing nothing, at least this year, unless the situation changes.
Okay, so I get the reaction from risk assets, but I look at the smart money, Vince. Why are bond yields down so much? And that's a pretty big drop, 10 basis points.
It's a lot, and all I can say is that's possibly positioning. There was a lot of selling in the last few days, and maybe this is just repositioning, taking some of that back. I'm totally with you. Looking at the smart money, I'm kind of scratching my head. I think over the next few weeks they're not going to look so smart by doing something like this, but we'll find out if I'm right.
And dollar DXY down 0.4%. You see a reversal there as well, right?
Yeah, I think we're seeing a bit off the lows. I would be surprised. What I would be looking at if I were trading today, probably initially getting run over, but at the same time, this is like I'd be salivating at fading these moves. Watch for the European close. Look to see if we get some profit taking going to the European close.
Always great insight from Vince. Vince Signorella, Bloomberg macro strategist. Thanks a lot, Vince. Do you use TikTok?
I do.
I'm so disappointed in you.
Are you?
Well, it's not just a platform, I guess, for these inane short videos.
Mm-hmm.
It's also a big selling tool for businesses, especially small businesses.
Most definitely.
At least that's what I'm told. So it may go away Sunday, and Matt Schettelheim is Bloomberg Intelligence media litigation analyst with us now for an update. Matt, thanks for being with us. Real quick, can you just give the background for everybody so we're all on the same page? It's supposed to go away.
Yeah.
It might not.
Yeah, so the date is, as you said, January 19th in the law, that on that date, the ban is scheduled to take effect. And what we've been watching here is whether TikTok can succeed in its First Amendment challenge that it argued at the Supreme Court on Friday. We were actually waiting for a decision that could have come at 10 a.m. this morning. The Supreme Court sort of did a head fake on us and said it was releasing opinions today. It released 2 opinions. Neither of those were the TikTok decision. So the wait will go on as to when the Supreme Court is going to address whether that ban can take effect on Sunday.
So as we think about this whole situation, how much is ByteDance budging? Are they budging at all?
We've had very little indication that ByteDance is willing to do a sale. That is the path around a ban, is a genuine divestiture that would let TikTok continue, but with a different owner, one that isn't located in China. And from the beginning, ByteDance and TikTok have said that's not feasible, and they are not pursuing it. So we don't know what's happening behind the scenes, but there's been no signal from ByteDance, at least, to suggest that it is willing to pursue a sale like that. It's been pursuing its legal challenge, and so it's not clear that it's willing to do a sale, or that China would be willing to approve a sale, especially a sale that involves the algorithm that is really the secret sauce that makes TikTok go.
Hey, Matt Schettelheim, did we get any indication in the arguments which way the justices would be leaning?
Yes, so if I walked away from that argument as TikTok, I was not feeling very good. And we saw this at the lower court, the DC Circuit, where TikTok lost on a 3-0 vote. It was a very similar feel at the U.S. Supreme Court, where TikTok needs to get to 5. It needs 5 justices to vote to strike down this law, or at least to halt that deadline. And it's very difficult when you look at those questions from the justices on Friday to get to 5. I could see one. Justice Gorsuch had some difficult questions for the government. Maybe you can squint and see 1 or 2 more joining him, but getting to 5 is much easier for the United States, just as the United States prevailed in the D.C. Circuit.
Matt, I mean, if we think about this in action, what would actually occur if we were to see a TikTok ban? Are we seeing an immediate erasure of the app on people's iPhones and Androids? What does that look like in practice?
It's a great question. So no, the law does not operate by stripping it off everyone's phone. If you have the app on your phone, it will remain on your phone. The way the law operates is it says that any company that carries TikTok in an app store, or that does internet hosting service that makes TikTok available, faces liability of $5,000 per user. So you do that math, 5,000 times 170 million users, and you get to absurd numbers, $850 billion of potential liability for any company that continues to make TikTok available in those ways on January 19th or after. So we don't know exactly if TikTok's going to try to go to some hosts outside the United States to try to keep the lights on. It told the justices at the Supreme Court it's effectively going to go dark on January 19th. We'll see exactly how that plays out. Either way, it's very likely serious trouble for the app on January 19th. Even if the lights stay on, it's going to be stitched together and barely held together, and the wheels would be slowly coming off, it would feel like.
I know you're the litigation guy, just like in 20 or 30 seconds, real quick. The impact, I mentioned like goofballs who use this all the time to look at, I don't know, cat videos, but businesses, especially small businesses, is this really a huge impact for them? Again, like 20, 30 seconds.
Yeah, so they brought this case. It wasn't just TikTok. The TikTok users also brought this litigation and said, look, this is a big deal. We've tried alternatives and they don't work as well. And so, but there was some skepticism from Justice Alito at the court. Is this kind of like an old shirt that you kind of like wearing, but you don't really want to try the new one? Maybe you'll be just fine with the new one.
All right, Matt. Always a pleasure. We appreciate it. Matthew Schettenhelm, Bloomberg Intelligence media litigation analyst. And again, the betting, it seems right now, Nora, is that Sunday, in fact, it is going to go away.
Doomsday for some people.
And what are you going to do? How are you preparing?
You know, I might cry.
I can't wait.
To see the tears roll down my face.
This is Bloomberg Intelligence.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Bloomberg Interactive Broker Studio. I'm Lisa Mateo. We've got stocks rising more than 1%. This is after a key measure of U.S. inflation eased for the first time in 6 months. Core consumer prices rose just 0.2%, and that was thanks to lower hotel rates, smaller advance and medical care costs, relatively tame rent increases. We also received some housing data today. The MBA says U.S. mortgage rates topped 7% last week, reaching the highest level since early May. Later this afternoon, we get a look into the Fed's Beige Book. Tomorrow, we move on to retail sales, a weekly report on initial jobless claims, and then Friday, it's housing starts and industrial production. So let's get to stocks. We have the NASDAQ up, look at that, more than 2%, 446 points. The Dow up 1.5%, 700 points. The S&P 500 up more than 1.5%, 104 points. Yields falling. The 2-year yield, 4.27%, down 9 basis points. And look at the 10-year yield, 4.64%, down 15 basis points. Over to commodities, the Bloomberg Dollar Spot Index down about 0.3%. We have the Japanese yen up more than 1%. The euro British pound stronger. We have Bitcoin up more than, nearly 3% at just over 99,000. Sources saying the U.S. are going to unveil more regulations to prevent advanced chips from being sold to China. So I wanted to see the effect of that. So you have TSMC down 2% in Taiwan, and then you have Samsung down about 0.3% in South Korea. NVIDIA, Intel not affected. We have NVIDIA up actually nearly 2%, and Intel up more than 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. John.
All right, Lisa, thanks very much. I'm John Tucker. Nora Melinda, your subs today for Bloomberg Intelligence. As Lisa just told you, risk assets, well, bonds too, also surging after today's inflation news. Let's get some more insight. Lauren Seidel Baker is economist and senior consulting speaker at ITR Economics. So, Lauren, I get it. Core is down, but is this an overreaction? I mean, it's not down that much.
It's not down that much. If anything, I see this as a continuation of the trend we've been on. We like to see those splitting hair surprises to say core not, quite so elevated as we have been. Certainly beat expectations. The market's going to like this for at least a few minutes, but I really think this keeps us on track with the trend that we've been seeing.
Lauren, what really stuck out to you through this report today?
So it's good to see shelter costs. Those contribute for just such a large percentage of overall CPI. Still rising, still one of the stickier aspects, the stickier components of inflation, but starting to cool off a little bit more. Again, housing affordability is going to be a concern going forward. We know that. We're seeing more folks looking for rents, right? Demand for apartments is up. Vacancy rates very, very low for apartments. So the rental component, I do expect that to be a little bit stickier going forward. Otherwise, though, the big drivers here, things like airfare, medical care, those are things that we know do cost more. So no big surprises, especially on the core front. I think this is a manageable result, and I think this, again, keeps the Fed on pace for those 50 basis points of cuts this year.
Okay, so maybe we're headed, the trajectory is headed in the right direction, but you know what? Maybe tariffs are headed our way, and there are a lot of iffy situations coming up.
Yes, tariffs are a big one. We have seen, if we break down inflation to the goods components and the service components, goods really have been mundane. Now, in this most recent print, energy prices starting to come back. We have been enjoying lower oil prices, right? Lower gas prices at the pump for a while. Starting to see a little bit of pressure building there just with the macro cycle picking back up. But if we do get tariffs, especially those universal tariffs, that could drive more broad-based inflation on the goods side of things. Service sector, again, labor market is tight. It is going to remain tight for the foreseeable future. So our base case is just for wages to cost more, for wage inflation to be higher going forward. It's really the risk to me if tariffs bring the goods side back to keep up with the wage side of things, with the service side. That's when we could start to see inflation really reignite.
When we think about the idea of tariffs, Lauren, are there any particular sectors or industries that you're keeping an eye on?
So much of this remains political at this point. Maybe we'll get one company asking for waivers on one thing or another, but really, if we do get tariffs that are universal tariffs, that just affect everything coming into this country, not targeting just China or just, some other jurisdiction, some product line, that's where I see the real risk. So I'm waiting to see what the incoming administration releases for their policy proposals. Some of this might just be campaign rhetoric that they leave behind on the campaign trail. They do target those kind of high value, really buzzy items like steel or things that are more targeted to China. I just think at this point it's a political decision. I won't be a political analyst. I'll just analyze the economics of it.
Lauren, as we think about the trajectory for the Fed's policy this year in 2025, is the focus really on employment data, inflation data? It feels like that has shifted as we've been moving the past couple years. What are you keeping an eye on? Which prints really are most important to you?
I am absolutely focused on inflation. So we have seen the focus shift from Fed messaging in recent months and quarters. Really, that's because when rates started coming down, they're looking at the employment side of their dual mandate. They're saying we don't want further loosening in the labor market. As I follow the jobs market, so much of that is just based on demographics, the number of jobs we need to fill versus the number of workers we have to fill those jobs. Right now, that is still not a one-to-one ratio. We have more than one job opening for every one unemployed worker. So if we're looking at loosening in the labor market, I don't expect a major recession, a major economic event this year. What could cause that loosening is more people coming in, right? More either students leaving school, aging into the workforce, more existing prime age workers looking for jobs who hadn't been participating in the labor market. Neither of those things seem particularly likely right now to really sway the tide. So I see the labor market as, yes, directionally loosening, but still very tight by historical standards. And that isn't going anywhere just due to the numbers of people and how they balance out. So with that said, the Fed can't really put too much pressure on that side of the scale. And inflation is the side. We have a lot of fundamental drivers that are starting to signal inflation picking back up, especially by the latter half of this year. So my concern as an economist is, we don't want to take the eye off the ball of the inflation side, because if that does pick up, I think there's a very reasonable chance that we could see the Fed start to talk again about raising rates by late 2025. I don't think that's off the table.
So as an employer, I can attract employees because I'm going to pay them more?
At the end of the day, you can do a lot for culture. You can reach out and have a mission.
Well, no, I'm getting to the inflation component, culture.
Okay. No, but at the end of the day, that's what folks are looking at. How do you attract someone to you and not the group across the street? This generation is a little bit more willing to move. They're sure we love the mission. We love to be part of something. But at the end of the day, the dollars are what make it work. So yes, that's why wage inflation is so elevated, and I would expect it to continue to be so.
The culture.
The culture.
Well, I get to work with Nora. That's why I'm here.
I get to work with John.
Oh, it's a real love fest, isn't it?
And it's not even February yet.
What's your expectation for, we'll put you on the spot, when are they going to cut? Yeah, you mentioned raising, actually.
Mm-hmm. As for when they cut, I don't have a horse in that race. I think 2 more cuts is a reasonable expectation, but if it's only 1, I'm not going to lose sleep over that. Directionally, we're seeing rates increase. We've already seen inflation expectations bring kind of market rates back. If you look at even mortgage rates, those are back above 7% this week. So the impetus is really to the upside, especially by second half of this year. So the ultimate timing of that exact low, the exact level within 25 basis points, again, that doesn't matter big picture. We don't need to split hairs. We need to look at the general direction. If you need to do borrowing, either as an individual or business, this is probably the time to do it.
Lauren, you mentioned that shelter costs are still a bit sticky. Can you just give us a bit more detail about what's going on in the housing space?
Sure, housing is tight. We have been underbuilding homes in this country. So household starts have not kept up with new household formations. We just need more inventory. Now, that's a hard thing to do today where mortgage rates, as I just said, are above 7%. That is really taking a bite out of affordability, not to mention the value of those homes. The list price has also really picked up since 2020. So it's a tough scenario out there for would-be first-time home buyers just trying to make those dollars stretch. And we're also seeing much less inventory come on the market up for sale. So existing home sales have been more subdued with, as I'll say again, that rapid rise in mortgage rates. Why would I sell my house with a 3 or 4% mortgage rate if I have to buy another one with a 7% mortgage rate? that's a lot less house that I can get for the same monthly payment. So we're seeing folks just stay in place a little bit longer. In the past, I'll say 6 to 9 months, a lot of folks have started to just bite the bullet. If I really need to move, I will do so. But again, affordability is the big constraint there. That's what's keeping many individuals in rental situations for longer rather than going out and buying that first home. And those problems really aren't going away. So affordability is the name of the game. What's going to matter is balancing that aspect with the wage inflation I was just talking about. More people being employed, making more money, they have more money to spend on everything, but housing is one major expense. So we're seeing some improvement in just our ability to afford housing, but the affordability numbers themselves much worse than we were just a few years ago.
And just anecdotally, I should point out, at 3.2%, they're going to bury me in the basement. Of course, if the price is right, I can be out in 10 minutes.
That's true. You all like to brag. Anyone that has a great mortgage rate in place, you know, we got to hear about it for sure.
Oh, Mike McKee, 7%? What does that do?
That keeps people sitting on their hands. Although the interesting thing is it came out of the same day we saw a 33% increase in mortgage applications last month. Most of that was refi, and I'm not sure why people were refining when rates go up.
I'm curious.
But
Mike McKee, stop. Lauren, I didn't mean to upstage you. Lauren Seidel Baker there, the economist, senior consulting speaker from ITR Economics. Thank you very much for stopping by today. Mike McKee, our economics correspondent, among other things, hanging out his shingle. What was your big takeaway from the inflation report this morning?
Good enough. It wasn't too hot. It wasn't too cold. We had a little bit of extra strength in the headline, a little bit less in the core. Both went up on a year-over-year basis, but less than anticipated. So the markets are taking that as
I wasn't too excited but the equity market, even the bond market, is pretty excited about
NASDAQ up more than 2%.
Well, I think you're not looking at anyone in the markets who's looking at what the actual impact of this is on the economy, and they don't expect it to affect the Fed meeting on January 29th. Everybody's waiting for next Monday. And what does Donald Trump do? So there was all this nervousness in the markets, and everybody was pushing yields up, which hit the stock market. And today, it gave them a reason to exhale. Wait till the end of the week. We'll see as people get more and more nervous about what Trump may do, whether that continues.
Yeah. As we think about this in about 20 seconds or less, how are you thinking about the fact that we are still not at that 2% target? What do we need to do to get there?
Keep it up. And that's why the Fed may keep rates on hold for longer than possible, or longer than thought, because they've got to keep, at this point, the pressure on to keep it going down towards 2%.
Okay, Mike McKee, Bloomberg International Economics and Policy Correspondent, reacting to 7% mortgages and today's CPI. Risk assets like it. Well, even the bond market likes it. S&P 500, 99 points higher, up 1.7%. The Dow up 680 points, and as you mentioned, Nora, the tech-heavy NASDAQ, we have to say that, is up 451 points. You're listening to Bloomberg Intelligence.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks on the rise. Bond yields, they're sinking. This is after that slowdown in consumer prices boosted the hopes that the Fed is still going to be able to cut interest rates this year. We'll start with the NASDAQ, up more than 2%, 423 points. The Dow up nearly 1.5%, 616 points. And the S&P 500 up more than 1.5%, 94 points. The two-year yield, 4.26%, down 2 basis points. The yield on the 10-year, 4.65%, and that's down 14 basis points. Taking you over to commodities, we have Brent crude up more than 1%, $80 a barrel. WTI crude at $78 a barrel. The Bloomberg Dollar Spot Index down about 0.3%. The Japanese yen up more than 1%. The euro, British pound stronger. We have Bitcoin up more than 3%. Right now, it's just above 99,000. Few companies making news. It's Tesla. Sources saying it plans to suspend part of the lines manufacturing that recently refreshed Model Y SUV in Shanghai. It's for about 3 weeks of the Chinese New Year so he can better optimize equipment. And then meanwhile, Tesla owner Elon Musk being sued by the SEC. He says that they say that he cheated Twitter shareholders out of $150 million, waiting too long to disclose his growing stake in 2022 ahead of that takeover bid. And yesterday, we learned about job cuts over at Meta. Well, today, Microsoft in the spotlight. Sources telling Business Insider the company laying off employee teams, including security, sales, and gaming. No word on exactly the extent of those cuts. For on-demand news 24 hours a day, subscribe to Bloomberg News now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. John and Nora.
All right, Lisa, thanks very much. I'm John Tucker, along with Nora Melinda. This is Bloomberg Intelligence. We're in for Alex and Paul today. And Nora, we've been talking about 7% interest rates, 7% mortgage for the 30-year. You cover the home building stocks.
I do. So
what has, if any, do we know the impact so far?
I mean, it's so interesting. I mean, we've been seeing home builders rallying off of this idea that there's limited inventory. I mean, we usually see people going to buy a house when they're looking for first-time home buyers. They're going toward existing homes. But because that's been so scarce, you've seen home builders really rallying and capitalizing on this idea of limited inventory. But now as we're looking at what it could look like for Fed rate cuts, we're also starting to see a lot of these home builders reporting, high inflation. We think about labor costs. We think about tariffs. These are all things that home builders are thinking about right now, as we're heading into earnings season.
With 7%, do they have to step in and start offering incentives?
Incentives have been really huge for home builders over the past couple years, and that's also been slightly weighing on their margins. So that's something that a lot of analysts and investors are keeping an eye on. So they've been doing this thing called rate buy downs, where they'll actually partially pay towards somebody's mortgage if it's super high, and it's bringing rates down for individuals down to about 5% in some cases.
All right, regionally, I want to break it down because you do, as I say, cover the home builders. What are the booming parts of the country?
A lot of people like to look at what we call the smile area. So, I mean, in a lot of different cases, it really does depend regionally. But in the South, we've seen some areas that have been doing well, and we've really just been keeping an eye more broadly, not as much into the recent specifics.
People are moving because the homes are available there or because the jobs are available. Does one follow the other?
Maybe it's a combination of both. Who knows?
Okay, so where do we head from here, do you suppose?
That's the question. I mean, I cover not only home builders, but I also cover commercial real estate as well. So I've also got my eye on office. I've got my eye on hotels, everything.
Differentiate between the two. What are the things that move this market and move that market as it pertains to commercial?
Of course, it's rates. I mean, when we think about borrowing costs, that's what's really huge for the commercial real estate industry. So if we were to look at office in particular, we have been seeing a slight uptick in terms of occupancy rates around the New York City area, specifically on Park Avenue. So that was an area that we saw a lot of different companies fleeing from, like Blackstone when the pandemic hit. But we are starting to see people trickling back in as people are really being lured by these new buildings that companies are really trying to push to get their employees back in the office.
So it's almost like, forgive the pun, but a tale of two cities.
Mm-hmm, most definitely.
Commercial real estate. The older stuff, it's not going anywhere, so you have to build the new stuff. It's
about what's most attractive. I mean, to your point, if you're thinking about a worker and they want to come into some, Class C B building versus a Class A building where you got a nice coffee machine. It's really beautiful. It actually makes you want to come into the office, but not only the office itself, but where you're located. Is it close to a place where I can get lunch, or close to a place where I can get something to shop for, and different things of that nature, things that these companies are really considering to really make it reasonable for them to take on a new lease with a
And even
landlord.
close by our building right here, there's still vacant storefronts. I'm
Exactly.
thinking just directly across the street at what used to be, you know, the lingerie
Zara?
place.
No, what was over there? Maybe I missed that one.
But that, and then you go to the west side
Okay.
with all the new structures over there, and that is just booming.
It's insane. I mean, that's what's super important when we're thinking about how people are viewing office and the importance of where you are located.
Okay, a reset of the markets right now, as Lisa was saying. It is a bona fide rally today in risk assets, as well as the bond market. The S&P 500 will take that as our standard bearer, up 95 points. That is a rise of 1.6%. The equity market is expensive, so today it just got a little more expensive. Let's bring in our next guest. Ann Berry is the founder and managing partner at Threadneedle. And like I say, it's expensive. Is it worth it?
I don't think it is, and I've been saying that for a while here on Bloomberg. You know, when you look back over the last 6 months and longer, the equity risk premium compression has just been extraordinary in light of the volatility, both with the macro data and with the geopolitical situations we've seen. It's been expensive for a while, and I think the market's waking up and going, hang on a second, have we underwritten this incorrectly over the last year? And I think we're seeing a little bit of nervousness coming into this year as things get real.
So if the equity market is not necessarily worth it due to how expensive it is, what asset classes are you recommending when you're speaking to clients?
You know, I have gone back to holding cash. I'm sort of back to where we were, really waiting to see if there's a correction. I think we're only seeing the beginning of a correction. And the reason I think that is I have long been saying we're going to see interest rates significantly higher for significantly longer than the market's expecting, which means it's not a bad moment to hold cash, and it's not a bad moment to wait for some of these valuations to break before coming back in. It almost feels like the market's caught itself up in a retread of there is no alternative, the Tina moment that we had during COVID. It's just a different version of it right now, which is a little frightening.
And after any correction, would you be all in then?
If there is a correction, there are certain areas that I would be in, and so I can be specific on that point. There are certain pockets of more defensive consumer that I'd be interested in. Walmart is an example of that. I think that's a fantastic diversified business. We haven't even begun to scratch the surface of what its capabilities are around data analytics and tech. If you look at what's going on in retail, a third of every incremental dollar is being split now between Amazon and Walmart in spend. 76% is split between the two. That's the kind of business with a big moat where scale is going to win over time. There are other areas where I would say it's not just about valuation related to some of the macro sentiment. We haven't seen enough fundamental justification for some of the valuations. And we look at big tech, we see the $240 billion of spend on AI that we saw fueling their CapEx budgets last year. This is the year where the market says, show us the money, show us that return on investment, show us the operating KPIs that show that you are getting adoption of the technologies you've been investing behind. And if we don't see it, I don't necessarily think that a valuation break at the surface is still the justification to go in. So it's really a sector by sector play this year.
So, Ann, we had CPI data today. Also, we're still digesting that PPI data from earlier this week. How are you thinking about the trajectory for Fed rate cuts this year, if at all?
Well, look, I was firmly in the camp when the Fed decided to cut at the end of last year. I was surprised. And I was surprised because that, to me, was a deviation from the data dependency, the data-driven decision-making that Fed Chair Jay Powell, I think, has actually done a pretty good job of advocating for. The data, to me, didn't point to it. I think the CPI data that we got today is another reason why that was a surprising move. Yes, we saw a little bit of cooling. It is still well above that 2% target. It's handily in the threes. We didn't see cooling at a rate that was expected. And I think that translates now into a market that's no longer interest rate sensitive. It's self-inflicted expectation sensitive. And so when I look at where I think the Fed moves, I wouldn't be surprised if we don't see another cut at all this year until perhaps Q4. And even that's utterly dependent on what this new administration does when it comes to fiscal policy.
Ann, always a pleasure. Thanks for stopping by today. Appreciate it. Ann Berry is the founder and managing partner at Threadneedle. discussing the latest on the markets. As we look at the markets, once again, the S&P 500, 91 points higher. That is up 1.6%. The NASDAQ 100, 2% higher. You're listening to Bloomberg Intelligence. I'm John Tucker, along with Nora Melinda. We'll be right back.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
And they're not here today, so we are. I'm John Tucker, and she's Nora Melinda. The headline crossing this morning from BlackRock, you know, it had to do with assets under management, and that number, I can't even comprehend it. So let's find out a little more and talk to somebody who can probably comprehend it. Neil Sipes is with Bloomberg Intelligence, the financial analyst. How much is under management at BlackRock? BlackRock is the biggest in the world in terms of asset managers.
Yeah, that's right. And the number now is 11.6 trillion.
Wow.
That's a T.
Trillion with a T, right?
With a T.
And what's really interesting is, you know, that number, you know, blows people's minds away, especially if they're not following the name closely. You think about the rule of 72, how many years it takes to double. Their assets have grown 10% a year over the past 7 years. So that's how we've sort of gotten here. 2017, we were at 6 trillion. Now we're at 11.6 trillion. So, you know, effectively doubling. A lot of that, of course, is markets. But with BlackRock, what we know is sort of premium organic growth. That's net inflows of client assets. That's been their strong suit.
Neil, as we look at earnings, what were your biggest takeaways for this company?
Yeah, I think the biggest takeaway was that at $11.6 trillion, the question of can you still grow at that scale is sort of answered here. And we've seen that, you know, the $200 billion in long-term flows in client assets, That's 8% long-term organic growth. That's one of their best quarters in a handful of years, and it's at the point where they've been the biggest they've ever been. So they're proving that, you know, the bigger they get, the growth is still there, and a lot of that speaks to sort of the breadth of that franchise, where we know they have the massive iShares franchise, the legacy sort of active mutual fund franchise, and now that push into private markets.
As a client of BlackRock, how much money am I making with my stuff?
Yeah, well, I guess it's going to depend what sort of products you're investing in, but a lot of what they've sort of typically done, or legacy, when you think of BlackRock, is a lot of those beta type products, the simple iShares ETFs that are going to track an index or an index mutual fund that you might find in your 401k or in your retirement plans. So that's going to vary by product, but what I think is a bigger story in asset management as well is, you know, the fees that are associated with those types of products. So we know that BlackRock is huge in that sort of passive realm. That's where fees are lowest, but we know that's where investor demand is, so that's where those assets are growing quickest. On the other side, in the asset management industry, we call it the barbell strategy. Passive on one side, that's low fee, high growth. On the other side, you have the higher fee, high growth, and that's private markets.
I guess what I'm asking is, what is the secret sauce that attracts so many clients to them? Is it the low fee aspect of this?
Yeah, I think it's a combination of both performance and sort of competition on price, right? BlackRock has the scale to be competitive on price, so they can effectively either undercut competitors or at least justify, you know, the fees with performance where necessary. And you have BlackRock that's pretty much embedded with all financial services, all financial institutions across the world, wealth advisors, down to the self-directed brokers, defined contribution providers. All of that sort of makes their products permeate pretty much everyone's portfolios, from retail all the way up to institutional.
So Neil, BlackRock also mentioned, they announced that they were going to be having a shakeup in management. So one of its most senior executives, Mark Weidman, will be exiting this spring. And
why would you shake things up if things are going so well?
Right.
Don't shake anything.
He was also seen as a potential successor for Larry Fink, the CEO. So what are conversations like? What are you hearing in terms of how people think about who could potentially replace the CEO, and if there's any sort of, instability there?
Yeah, I don't necessarily view these headlines as a, indication of instability. I think we know that BlackRock has a pretty strong bench. You are, at times going to see higher profile people depart certain firms. Larry's been at the helm for, over 30 years at this point, since co-founding BlackRock. So that's always sort of been a question that's sort of in the back of investors' minds. It doesn't sound like it's, on the verge of being announced or anything changing, but, ultimately that's one person out that may have been sort of potential heir to the CEO, but we view the bench as pretty solid and don't see that as a negative.
All right, so what do you do for an encore? Larry thinks this is just the beginning, I think he said, or whatever.
72 years old.
Yeah, right, and some may even call the past 12 months the encore, where he, strung together 3 pretty sizable transactions in private markets, Global Infrastructure Partners, Preqin, the private markets data provider, and then just recently HPS. That has significantly shaken up the firm in terms of how those fees are going to be generated, where the growth is ultimately going to come from. So that's perhaps sort of the latest in the legacy of Larry Fink. And ultimately where that goes is going to be the question, but it feels like more of the same, more on the passive ETF side of the business, as well as now into private markets.
Neil, thanks very much. Appreciate it. Thanks for stopping by today. Neil Symes, Bloomberg Intelligence financial analyst. BlackRock, again, the headlines, attracting a record $641 billion in client cash in 2024, with $390 billion flowing into the ETF business, $226 billion into their equity equity funds, a record client cash, and also revamping the leadership team. As we reset the markets right now, S&P 500, 91 points higher. That's up 1.5%. For our listeners in the U.S., reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121, presented by Oracle. Stay for the latest market news and industry research straight ahead. The next hour, Bloomberg Intelligence, starting right now.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Welcome back to Bloomberg Intelligence Radio. I'm here filling in for Alex Steele and Paul Sweeney here alongside Matt Miller. See, I wanted to give you a chance to say your name. Never that, never that. We're looking at markets right now. We're seeing the S&P 500 up 96 points, rising 1.6%. We've got the Dow up 1.5%. That's rising 665 points right now. And the NASDAQ is on a roll. We're seeing it up more than 2%, rising about 400 points right now, Matt.
I want more young people to cite the Dow Jones Industrial Average.
See, I should have started with that one.
Yeah, I mean, you know, Katie Greifeld is always citing the Russell 2000. She says the kids are about small caps. You know, but massive rally after CPI came in cooler than expected, plus bank earnings all doing better than the Wall Street forecasts. I think the analysts kind of sandbagging a little bit there, but nonetheless, we are off to the races and just 60 points away from 6,000. Let's get over to Charlie Pellet. He's got a Bloomberg Business Flash.
Thank you very much. Dow, Russell 2000, I got you covered. Here's what's going on. Dow, S&P, NASDAQ, and Russell 2000 index all ripping higher. Bank earnings Wednesday, CPI Wednesday, a lot of moving parts to this market. Right now, we've got the S&P up 1.6% and the Dow Jones Industrial Average up 1.5%, up now by 656 points. NASDAQ Composite Index up now by 405 for NASDAQ, a gain of 2.1%. Russell 2000 Index of small cap shares up 1.9% with a 10-year 4.66%, the 2-year 4.27%, the 30-year 4.87%. Gold up $1.70 the ounce, little changed, up less than 0.1%, $26.79. West Texas Intermediate crude up 1.6%, $78.76 a barrel. Brent should not neglect Brent crude because it is trading back above $80 a barrel. And Bitcoin once again closing in on $100,000, 99,184 on Bitcoin, up now by 2.8%. Consumer prices up in December by less than forecast, a welcome step down that helped ease a deep sell-off in bond markets and reinvigorate bets that the Fed will be cutting rates sooner than previously thought. Lauren Seidel-Baker is an economist at ITR Economics, the Institute for Trend Research, and she was a guest right here on Bloomberg Intelligence.
The big drivers here, things like airfare, medical care, those are things that we know do cost more. So no big surprises, especially on the core front. I think this is a manageable result, and I think this, again, keeps the Fed on pace for those 50 basis points of cuts this year.
Lauren Seidel-Baker of ITR Economics interviewed on Bloomberg Intelligence. Bank stocks ripping higher after earnings this morning. JP Morgan Chase up now by 1.4%. Citigroup surging 5.4%. Wells Fargo up 6.2%. Goldman Sachs up by 5.5%. And of course, tomorrow, Morgan Stanley and Bank of America. And Morgan Stanley up now by 4.2%. Bank of America up now by 4.1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Charlie, thanks very much for that. Charlie Pellet there with your Bloomberg Business Flash. Matt Miller here in the Bloomberg Interactive Broker Studio with Nora Melinda.
Hello.
Going to take you through the next hour of trading, and luckily we're looking at green across the screen. It's not so optimistic out in Los Angeles, where I gather the wind and the weather are making it, continue to make it difficult to contain those tragic fires. Let's get over to Rob Carolyn right now, Bloomberg meteorologist, to get a check on that. Rob, what is, I guess the wind update is probably the most important thing to get.
It is, and we've actually done better than expected, Matt, both yesterday and it looks like today the wind's not quite as high as we were fearing. It's still going to turn breezy across Southern California this afternoon. Red flag warnings are in effect. But yesterday we were thinking they'd be seeing 20 to 40 mile an hour winds with gusts to 65 miles an hour. Now it looks like they'll be looking at 15 to 25 miles an hour with gusts to 45 miles an hour. And with those lighter winds, they've been able to do better. The Eaton fire is now 35% contained. The Palisades fire almost 20% contained. So the lighter winds have actually been very helpful. If we can get through today, things start to get much better for Southern California as the winds turn onshore and start to bring cooler air in off the Pacific, but more importantly, more humid air in off the Pacific, which will definitely help with fighting those fires.
Rob, quickly, which areas, which regions have been the most hard hit?
Norma, it has been the areas to the northwest and east of the Los Angeles area, up in the higher terrain of those areas where we've had the winds last week gusting over 80 to 100 miles an hour. San Diego County had some problems late last week. They're out of that and don't have the issues today. So it's more or less from Oxnard through L.A. and up into the mountains to the north and east of the L.A. area that we're concerned about today.
Rob, thanks so much for joining us. Rob Carroll in there, Bloomberg meteorologist, giving us the latest update on the weather in Los Angeles. I want to get over to Isabel Lee right now from our cross-asset team to talk about what's going on in the markets today. Isabel, stocks are ripping face after we got this cooler than expected CPI reading.
I know, everyone is just happy you're seeing a relief rally. And to your point, I watched your TV show earlier today, and yields are a reason for that. And we have Fed rate expectations really adjusting to that. But I'm here to talk about individual stocks, aren't I? So we'll talk about NVIDIA. I want to bring this up because NVIDIA rallied an unbelievable 800% in the past 2 years. So that's really a stunning rally. It's hard to believe, but it has hit a stumbling block. The company is now facing pressures from all sides. We have slowing revenue growth, tougher competition, stricter regulation. And today you see the shares up by around 1.3%, but in the past 5 days, it was down. It slashed 12% since its record in January, but still, bulls are unfazed. They're saying that NVIDIA still has this path forward, but it's just interesting to see because remember when Goldman Sachs dubbed NVIDIA as like the most important stock on the planet Earth?
Of course.
Well, now, I mean, you can't go up forever. So now we have competitors and customers really stepping up to take a slice of that AI pie. But still, NVIDIA is still reigning supreme. We have the Biden White House looking to limit the sale of NVIDIA, but it's unclear how Trump will handle that.
Isabel, what else are you keeping an eye on here?
Tesla. So big tech is all the way here. We have the SEC claiming that Elon Musk cheated Twitter shareholders out of more than $150 million. This because he waited too long to disclose his growing stake in the company. Tesla shares are up actually still by just 3%, which is not really a lot if you're looking at Tesla. But still, we have the SEC complaining and accusing Musk of failing to promptly report that he had amassed more than 5% of Twitter stock in early 2022. So this is really a big claim, I would say. But Musk's lawyer obviously disputed the claim. They said that the SEC's multi-year campaign of harassment against Mr. Musk in a filing of a single-count ticky-tack complaint. That's a real quote we had in this story.
I mean, it's so silly that the SEC throws something at anyone with like, what do they have? 7 days, 5 days, 4 days left until they vacate the building. I mean, obviously, the Trump administration isn't going to prosecute Elon Musk on this.
That's fair, but you got to admire their gumption. And also, Musk has had a strained relationship with the SEC. Remember in 2018 when he tweeted, quote, funding secured, that also got him in trouble. But we also know that Musk is really like, I don't want to say close, but yes, he is close to Trump. And it remains to be seen how this will affect him with the SEC under a new leadership change with Trump's nomination of Paul Atkins. But yeah, why not shoot your shot while you have like a week left?
Right. Isabel, what else are you keeping an eye on your team just more broadly?
Are we talking about
working on?
ETFs in general, we're seeing what big trends are going to hit the market this year.
You know what was nuts?
What?
BlackRock, not only did they bring in $691 billion of new cash last year, but $390 billion of that was ETFs alone.
My goodness.
And I mean, I know your team focuses heavily on ETFs, right? That is not expected to slow down. So you could see a year in which BlackRock brings in $500 billion of client money on ETFs alone.
Everyone loves ETFs.
ETF was a major contributor. Cash management just placed second. And I think overall the firm really just had record annual inflows. But yes, ETFs are going to be a big story this year. I think almost every shop
Wait,
will
did you
have
say
an ETF.
record animal inflows?
Yes, BlackRock reported record annual.
Annual. I thought you
Stop,
said
Matt.
animal inflows.
Annual. That would
getting
be awesome.
distracted.
That would be a big headline.
2 of each, right? Up the ramp. All right, Isabel, great to get a picture of what's going on with some of the individual movers. Obviously, the whole market is ripping, not just on the CPI number and the lower rates, but probably also something to do with financials, right? I
Most definitely.
They all beat.
Don't we love them?
And they're
Keep an eye
all
on them.
up pretty big. Even Citi is up like 5% right now. Allison Williams joins us right now from Bloomberg Intelligence. She manages like everything there, but her main beat is the banks. And Allison, I guess it's a $20 billion buyback that's helped investors feel good about Citi, but didn't they take down some of their goals for the year?
Well, I think they sort of notched down their return on tangible equity target in the near term, but I think it's realistic. It's interesting. Even Goldman Sachs, who had like a blowout quarter, really strong numbers, it's tough to see them. They say they have a path to reach their target, but I think what all these banks did was after 2021, which was a blowout year, you saw a lot of people raise their targets, but not these very bullish targets. And JP Morgan has met their targets, but for everybody else, it's tough. And even with the markets as strong as they are. So,
but targets were pretty high, right?
Yeah.
I mean, Shonali keeps telling me that JP Morgan missed on equities trading, but equities trading rose 22%, right?
I think because they restated their numbers. And so if you look at the restatement, what happened was they shifted a little bit from equities to FIC. And so I think that's why it appears that they missed on the equities line, but really beat on FIC.
And FIC, explain to our listeners.
Income.
Okay, see us with
And
the
commodities.
acronyms.
Thank you. Yeah, it's an acronym that also doesn't do well in Germany.
Yeah, I'm not sure what it would be. Although Deutsche Bank only does FIC with one C because they're not.
That's good.
The more you know, the more you know. So
there you go.
Who's the front runner here and who are the laggards?
So, JP Morgan really continues to post the leading returns of the group. As I said, they're exceeding their target in the near term. We expect they'll meet their target again next year. But I would say that all the banks really had a good quarter, and it's not just the quarter, it's the guidance. And so net interest income coming in better than expected. Wells Fargo and JP Morgan in particular raising their guidance for net interest income for next year. With Citigroup, as we pointed out, they had the buyback is about 14% of their market cap, so that's pretty significant. I mean, keep in mind the valuation at Citi, and so that's why I think investors are even more excited about that.
Well, you know what? That brings up an interesting question. We have the inauguration in just a few days, and will be a different regulatory regime, not just throwing out the Basel III endgame, but I wonder if these banks are going to be able to do more buybacks. Are they going to be able to pay more in dividends? Are they going to be able to return more cash to shareholders?
That is definitely the thesis, if you will. And so a lot of the run-up that we saw in the banks was due to this lighter regulatory environment. A big part of that, to your point, is the capital rules. So Basel III Endgame, as we call it.
Sounds like a movie.
Yes.
Right.
So it will eventually happen. I mean, for the banks, it's probably a good thing, actually, if it happens under the current administration, because the current administration, as we know, is very U.S. focused. And a lot of the issues that the banks had with the capital rules was that it was very punitive versus some other jurisdictions. So it felt like it put them at a disadvantage, especially in something like prime brokerage. And that's not a business that regulators are necessary. Regulators generally, they're looking to protect the smaller banks and do things that, they're not as concerned with trading and prime brokerage. But to the extent that this administration, we would see the lighter rules come through, it could be good to get them solidified. The other thing, M&A. Less antitrust should be good for M&A.
Right.
It's actually a little bit of a
How
disappointment.
many banks are there in the U.S. in the United States of America? How many banks do we have?
Well, it's not
5,000.
It's not necessarily even the bank consolidation. It's the fees that they'll make advising other people.
Ah, right. Okay. So you're saying advising M&A for other industries.
Right. Okay,
I thought you were talking about in banks because, in some countries they have like 4 or 5 banks.
Right, just a couple that you can count on your hand.
In this country we have
a lot.
A lot.
5
I'm
million.
not far off with 5,000, right?
Yes, so you're not far off, but I mean the size of these GSIBs, as we call them, which are globally systemically important banks, I mean the big really have gotten bigger. They have consolidated share, and they've gotten bigger globally.
I don't know if Nora remembers, but there was a time when we were concerned about banks being too big to fail.
Okay.
I mean, you were probably in middle school at the time, but now they're
You don't know
even bigger. I don't know that. I shouldn't assume that your age is, but 2010 now is 15 years ago. So
It's interesting how times have
2008,
changed.
right? 17 years ago. What grade were you in?
17 years ago.
I don't think I'm allowed to ask, actually. Forget that. In any case, these G-SIBs are G-SIBier than ever.
Right. So I keep an eye on real estate stocks. So I'm covering office REITs. And one thing that I'm always looking at is return to office. So we did have JP Morgan saying that they're pushing people back into the office. What has been the general mandate and what has been the conversation for the banking industry in general?
In general, those that are front office, if you will, that are out there, we have this banking fee recovery, banks are competing with each other. So a lot of those senior people have been in office or traveling again, right? So a lot of, for investment bankers, a lot of it is not necessarily sitting in your office, but being out there and visiting clients. So we definitely saw that return to travel. And JP Morgan, even though the 5 days a week is getting a lot of headlines, the senior people at JP Morgan have already been back. People that I talked to at the company were back, May of 2020, they were back in their office 5 days a week. So, so definitely there is the return to office. Commercial real estate, as you know, was a big concern about a year ago, or I guess
talk to us about where that stands
now. But we're definitely seeing some stabilization there. And credit, we talked about the net interest income side of things. When you don't hear about credit, it means it's good.
Okay.
And so, office, commercial real estate is a significant business for Wells Fargo. We're always looking at the trends for them, and we saw solid quarter overall net charge-offs, very stable provisions, less than expected at Wells and JP Morgan, and that's a clear signal for Bank of America. And it also means that the credit outlook for 2025 feels good. And lower rates have really helped on the office commercial real estate front.
Interesting.
Yeah, very interesting stuff. Allison, thanks very much. I'm sure, is today the busiest day of your year?
Today is the busiest day.
But you look calm and
normally
collected.
we have 3, but today we have 4 big banks that I look at. We had BlackRock, we had Bank of New York. So, so busy bank day, but it's always easier when the numbers come in solid,
right?
And the trends are good.
And you're tackling it.
Allison Williams, thanks very much for that. She covers all the big banks for us at Bloomberg Intelligence. Matt Miller here in the Bloomberg Interactive Broker Studio with Nora Melinda. We are going to take you through this day, and it's not going to be painful because markets are up more than 1% across the board. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Wall Street breathes a sigh of relief. This Bloomberg Business Flash brought to you by Oracle. Attention, growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. That's for new U.S. customers with minimal financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. The Dow, the S&P, NASDAQ all advancing. We are off session highs, but the S&P now up 1.5%, up 89 to 59.31. The Dow up 604, up 1.4%. NASDAQ up 394 points, up 2.1%. And the Russell 2000 index of small cap shares is gaining by 1.8%. 10-year at 4.65%. The 2-year, 4.27%. Spot gold up $6.50 the ounce, 26.84, up 0.2%. West Texas Intermediate crude oil up 2.5%, 79.47 a barrel. Brent 81.45, up now by 1.9%. Brent rallying as the impact of U.S. sanctions against Russian flows continues to reverberate, and the International Energy Agency dials back its bearish view for the year. Among some of the oil names today, ExxonMobil up 1.1%, ADRs of BP unchanged on the day, Chevron up by 0.8%. Bank stocks, the big story, JP Morgan Chase up 1.2% after earnings, Citigroup up 5.2%, Wells Fargo up 5.9%, Goldman Sachs up 4.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charles, thanks very much for that. Matt Miller here in the Interactive Broker Studio with Nora Melinda. We are taking you through this trading day where equity indexes are absolutely ripping as rates come down. Nora, did you see the 10-year yield at one point was down 15 basis points? And that was the biggest drop that we've seen since August.
Wow. I mean, we are really on a roll here, at least in the equity market. I'm seeing NASDAQ up more than 2%, S&P up 1.6%. Lots to keep an eye on after that CPI data today.
Exactly. CPI came out. Well, the headline figure was still up month over month, 0.4%. But the core figure was only up 0.2%. We were looking for 0.3%. And that's what is behind the move. I want to talk about that right now with William Lee. He's the chief economist at the Milken Institute. And Bill, great to have you on the program. We'll just talk a little bit about the U.S. and then broaden it out to the picture globally because you have so much experience internationally. What do you think about the inflation picture? Because until today, the worry was inflation was back on the rise. The Fed wouldn't be able to cut as much as we had thought, and maybe, some said, maybe even would have to raise rates this year.
You know, it's always dangerous to go against the markets, but I still think rates, the inflation rate is on the rise. It really hasn't shown really signs of coming down ever since the fall. We have core inflation still hovering above 3%, and it's been persistently above 3%. But if you take away the goods and just look at services, that's where I'm really concerned, and that's where I think the Fed is concerned. We have services, ex-housing, forget about the housing component, over 4%. And that has been rising since late last year. So what we're seeing then is a situation where the downward trajectory to 2%, which the Fed really wants, really isn't in sight when you take away the goods disinflation, which we have seen take place because the supply chains have come back online. The real stubborn parts of inflation, the service sector, ex-housing, is the one that still shows quite a bit of persistence. And I think the Fed is going to keep things tight until they see that going into a downward trajectory, and we haven't seen that yet.
So, Bill, when we look at today's print, and as you were mentioning and talking about some of the details, do we think that the equity market rallying today is a bit of an overreaction?
Well, maybe yesterday's partial reaction to PPI and now today's reaction is just a sigh of relief that we are not accelerating upwards, that the overall index looks like it's relatively contained. But as I said, there are some vulnerabilities in that picture, especially when it comes to services. And I think if you're a real investor out there, you're going to be looking to see this rally fade, and more uncertainty that is coming because of fiscal and international events is going to keep investors on edge and not willing to commit a lot of money just yet.
So what do you think about tariffs? What do you think about, the labor market right now? We saw a blowout number, let's not forget, last week, and the incoming administration wants to deport people, maybe by the millions. How does that affect inflation at a time when we're trying to extend tax cuts and also deregulate?
Yeah, I talked to a lot of investors, especially global investors, and I think the consensus view around the world is that the United States still is the best place to put your money. I don't believe much in academic studies, despite the fact that I'm a card-carrying PhD economist.
I was going to say, didn't you study under Robert Mundell at Columbia?
That's right, and one of the great luminaries of the field came up with a paradox. He said, isn't it strange that emerging markets where there's capital poor, you find that a lot of the investors in emerging markets and the rest of the world are coming to where capital is really rich. United States, developed economies, and that's called the Lucas paradox. And I think what we're seeing today is also the fact that a lot of people are saying, despite all this talk about diversification, I want to go where the returns are the highest, where innovation is the highest, where we're getting the most for our investment dollars, and it's the United States. And I think global investors really feel that way and continue to feel that way. All this talk about Trump and the uncertainties about tariffs and how it might be the end of the world, and we have a repeat of Smoot-Hawley of the 1930s and throwing the world into depression. I think that those are analytics that don't even pass Econ 101. Those would be F marks if I were still teaching at Columbia. And the reason why is because I think people should read Trump's book, The Art of the Deal. Right? You always come out with a hard negotiating line, and then you sort of make a deal with people. And remember, Make America Great agenda, what's that all about? Maximizing high-paying jobs for Americans. That's really the agenda. And if foreign investors can come to this country and offer the opportunity to create more jobs for Americans, I'm absolutely sure the Trump administration would be jumping at that. Now, if it was China coming in, there's some high hurdles that they're going to have to meet. But in terms of our allies, the Canadians, the Mexicans, the Europeans, we are continuing to welcome investment funds to come into the United States to create new jobs.
But not the labor, right? I mean, we want to, during the campaign when Trump was talking about 15 million illegal immigrants, mass deportations were the signs being waved at the RNC. And in a tightening labor market, it just doesn't strike me as the smartest idea to send that many workers out. And not to mention the fact that we educate so many foreign citizens. Do we give them all the tools that they need to succeed and then send them straight home when they're done at our Ivy League universities?
And Matt, that's the paradox that I think all of the executives from Silicon Valley are trying to correct right now. The key word that you just said about immigration was illegal immigration. We want to sort of, I think the administrations want to put a clamp on the amount of illegal immigration, but they certainly want to optimize the amount of legal immigration, especially when we train a lot of the students. We want to be able to give them green cards to be able to stay here to make use of their talents. This country was built on the talents of immigrants from around the world, and the Trump administration has been saying all along they really want that. So the key is, how do you emphasize more talented legal immigration into this country?